Good morning, welcome to Trade Live IG on the 3rd of September. And today, oh my goodness me, better to be lucky than who is both lucky and clever. It's Pete Ward.
Morning, Rich. How are we doing?
Stressing me out this morning. I messaged Pete Ward at 6:30 going, now Pete, you realise that you're in this morning? Nothing. 6:45, I messaged him on his work phone. No, it's perfect. This morning, you're already on the train. Nothing.
I think I'm still on holiday mode with the old don't disturb on till 7ish.
Yeah. Oh no, I'm in your archive chat. So that's what it is.
Go straight into junk.
How you doing, sir?
I'm good, thank you. And yourself?
It's a while since we've been in here.
Yeah.
Do you recognise any changes?
I do indeed. This lovely new brick backdrop. Looks smart.
It's not bad, isn't it? And you're also in 4K there. So
wow.
We're going to have to get the.
You'll start wearing makeup.
Start. Right, so what do we got coming up on today's show? It was a big day yesterday in the market. We got a lot coming up Wednesday, 3rd of September. P and I are going to take you through till 8:30 this morning. So fast markets, we're going to cover some of the big moves that yesterday. Did it give trading opportunities or bear market fail? Commodity Corner, Angeline, Simon Popple's coming in. What better guest could we have to talk about gold than the gold master himself? Then we got all set as well. And then 9:10. What have we got, people?
The Art of Investing, episode 8.
Episode from episode 7 or 8.
I'm not too sure. This is the one that you're trialing as you're following what you're talking about as well, right? In terms of the portfolio.
I can't remember if we're on 7 or 8. Anyway, so that was the one that we did last week, and we are debating the Fed independence and then trying to work out if there's a trade that we got cash at the moment,
right?
Or we did when this was recorded.
Yeah.
Gives you a little hint that there is a change.
Mm-hmm.
We got 20%, and it's like, right, do we put a little bit more into gold or do we put some more into the US stocks? On whether the question over Fed independence worries us, and there is not an agreement.
Right.
So we had to take the decision as well as...
and there's 3 of you, right?
It's not a democracy, though.
No.
That's the hint.
Oh, right. I see. Okay. Well, all eyes on 9:10 then.
All eyes on 9:10, indeed. Right. Well, first of all, I want to know where you were at the weekend, because I was seeing a lot of pictures come up.
In the Lake District.
Very nice.
Yeah, it was actually. Yeah, it was really nice.
With the family?
No, with 2 schoolmates.
Lads trip.
Yeah, we were meant to be climbing up Scarfell Pike, but the weather was pretty horrendous, so we shortened it to a little loop instead.
When you say a little loop, are we
into a pub then?
Are we talking a 5K with a pub at the end of it?
No, a bit more than that. Yeah.
That was like our hikes in Austria.
Oh yeah.
When we went. I think it was day 5 of 5 hikes in a row.
Right.
And I was like, oh well, where's the lunch on the way? Mm. And the lunch was about half an hour into it.
Oh.
So it was a long lunch.
Nice. Perfect. That's all right on day 5.
It's the perfect hike.
Yeah.
Right, good morning to you. Parky's here. Wing it. I haven't seen you in there for a London guide. That's a new one.
That is a new one,
a tour guide in for us. Top of the day to you. And Poppy is in. So there we go. We're talking about investing. Mm-hmm. We're talking about the chairman is in the house.
Okay, very good.
Morning, chairman, sir. How are you, sir? So Chris is in there and he is saying, yes, of course, Rich. It was episode 8 indeed. This week's is episode 9. So there you go, episode 8 coming up. Right, some overnight action.
Yeah.
Good, right, and the guys are going to fix my TV as well because it has gone blank. The little teething issues from yesterday are just dropping into today.
Okay.
But I
see that
thought
one's blank.
with our VI.
Oh, there we go. We're back on.
There we are.
Look at that. Look at that setup. Wow.
It's beautiful, isn't it? Now, why did I start the
Chaos.
show? Better to be lucky than clever. What does that phrase mean to you, Pete Ward?
I guess maybe with talking about dip buying.
Dip buying was certainly, there was a did we hit the lows yesterday?
Yeah, it was about 6:30, just before I got in the car to drive back from Yorkshire.
Oh, you're saying you were the catalyst.
Well, I mean, it's always the way. I built a nice little short. Market was going even. Put a little sell some more lower down if it legged, and then as the market's done, pretty much every single day for the past 6 months, it bounced off the lows and rallied up through the stop.
So there we go. The guys are going to get that up for you. That is the NASDAQ 100 from yesterday. 5:15. Sorry, it was the exact low. We tried one at 2:30 on the dot. Surprise, surprise. They came in to buy the US Open, which was exactly what I messaged Poppy beforehand, saying they're clearly going to buy this Open down 1.6%. They failed. And they failed, and that looked like it might actually have significance. Were we going to go into a second day of selling in the NASDAQ? Now, that doesn't happen.
It was interesting to see it. It was interesting to see it hit the low and then come back and try it again. And if you bring up the S&P, I was sort of tracking that. One of the levels that I think people have been looking for on there has been 6408.
Right.
As a support. And yeah, I got an alert come through on the IG alerts basically saying 6408 is broken. And within about 5-10 minutes, it had a good old flush through that level.
Right. So the guys are going to get
retest,
that chart up as well. And there's what Pete's talking about. 6408 here.
Yeah.
Try and come up and test it again, didn't it?
It did. And then it failed again, which gave me confirmation. And obviously, the orange man saved it all again.
Well, it wasn't the orange man that saved it last night.
Well, it was the orange man a bit, but then it was also Google.
Yeah. So so I thought that we were in for a break last night. So I think roughly it must have been about 20 minutes into the US session. So when we were up here and it failed, I started to put on some additional shorts because I'm long Intel. I was long Marvel. And I just wanted, my only real shorts were Palantir and the defense names.
We long Marvel into results last week? After?
I was in the options market, yes, but I was short the 65 put, or I am short the 65 puts. So I got hurt there, but more from losing the premium in my calls.
Oh, yeah.
But I did start to buy them at 63.5. Got some at 61 yesterday. I was long tech. I'm short the puts on Palantir now at 150.
Okay.
So I thought, right, Google's had a great run. I've made some money there. I'll short some Google. So I shorted 100 shares, right? 2,000 and short them. When we got so annoyed. Bears one day. Get this book down. So I closed a lot of my lower conviction trades, which included the short Google at about 10 to 9. So $211. I went, I'm watching a TV program just now. The most random TV series. It's on Amazon, and it's all about the JFK assassination. Back in time to save JFK.
Right, okay.
Right?
Yeah.
And 1960, and he builds up a life following Lee Harvey Oswald.
Right, okay, yeah.
And then gets close to him.
And then stops him from...
Well, does he though?
Well, was it him?
Question. And also, when you're messing with history, does history come and bite you back?
Well, like the old butterfly effect.
It's pretty much based upon that.
Nice. Sounds good.
So it's I love the whole.
What's that got to do with you closing your Google?
Because I closed everything, went F this market.
Yeah.
I cannot believe it's rallied again. Watched an episode of this JFK, and I looked at 9:30. I looked down and went, sorry, what? We're 100 points higher than where we were, and then started looking at the Google stuff.
Yeah, so Google jumped, what, 7%?
7%. I almost took what that would have been $1,500 hit just on a
small punt.
On a small punt.
Yeah, well, shows the risk, but also the fact that these monster companies can move so much, and that was the antitrust.
Yeah,
yeah. So they're not going to have to pay the fines that they were thinking they were going to have to pay. They're not going to have to sell Chrome.
That's the main one. Is they're not going to have to sell Chrome. They're not going to have to sell Android.
They're just going to have to share some more data, basically, and be nice people.
Be
nicer.
Interesting though. And guys, if you can just fix my TV again, please. Then what happens is this has been 5 years with Google, right? 5 whole years. And the judge has actually changed his tune in the year, because it was the same judge that originally said that they were operating a monopoly. He's now said the advancements in AI are so fast and there's so many other companies doing great things that, to be honest, your search engine isn't as much of a risk as it used to. So we'll let it continue. But they do have to share their data.
Yeah. Speaking of AI, did you see the Salesforce CEO? He basically came out yesterday saying he's going to cull 4,000 jobs because it just doesn't need as many people because of AI basically taking those roles.
Right. AI doesn't affect any jobs. That's what we're told.
Yeah. Well, there's 4,000 going there.
Wow.
Yeah. So I mean, that's that could show you a small snippet of maybe the wider picture for all those sort of tech stocks as they slowly sort of roll out more and more.
Do we know how it was taken?
Let's have a look.
Not really too much, is there? No. Snowflake down 2% yesterday, but I'd be interested to see how that was taken, because of course Nike have just culled another a lot of restructuring. I think 1,000 jobs there, and Snowflake 4,000.
Salesforce.
Salesforce. Sorry, I was looking at Snowflake.
No, Salesforce. Yeah.
Because is one that's apparently getting, the market's very worried about the negative impact on software, isn't it? Good. Right. So we've China, and then we've got what was it actually caused by? It was
sell-off.
Yeah, it was this bond market rout.
Lots of different things. One is the speculation about the tariffs and the fact that the tariffs may have to go back to the countries that have had to pay them. Yeah. But he's going for a Supreme Court ruling on that, and it's going to boost something like 175 billion to the Treasury. You can't imagine them giving the money back. But they're basically claiming that, it wasn't legal. That then, I think, had a knock-on effect to bond yields. Bond yields in the UK and Europe were moving for different reasons. Instability, fiscal woes, budget coming up, all that sort of stuff. Yeah. And sterling had its worst one-day move, I think, since April. It's like 140 points. That went, and things like, obviously cable went lower. Sterling Aussie went quite a lot lower. That's been pretty well bid recently. That came down to like 205 from 210 only a couple of weeks ago.
Time for a trip to
Australia, they had good GDP as well this morning. And basically all these things just put little tremors out there, 5-year spiking, etc., etc. So there's all of that sort of stuff. And then...
So there's your bond yields there. So 30-year at 498 in the US, 566 in the UK, hit 570 yesterday. And then we've got France at 4.5%, Japan 3.3.
And there was a bounce. It kind of came back a bit, but it's since failed again. So sterling now under 134 again, 133.85. So interesting to see. the knock-on effect that will have. But yeah, that in the States, I think, was coupled with the usual seasonality. People talk about the first week of September after Labor Day, people come back from holiday, people come back to the screens. Markets have been kind of heavily frothed up. And, you know, one could argue that there'd be a case for some sort of rejigging going on. But yeah, a bit of bad news and then a bit of that perfect storm, a couple of key levels gone. You think, right, we're going to sell off here and have a proper flush. But
you've nailed the Footsie, haven't you?
Okay, yeah. No, I wouldn't say nailed it. Nailed it would have been keeping the underlying and all the options. You told me to get the options.
Yeah, no, I told
you said to me, you just go ground away. Away. No, they're all good. They're in the money now.
Yeah, not for long though.
What, you think we rallied today?
Well, the Footsie actually did have a really nice day. Sorry, a nice recovery. It touched down 91.
It has faded again though.
It's not. Yeah, it is bleeding, isn't it?
Yeah, it's thing. Like if you look at where, you know, sometimes things look out of kilter, the fact that the S&P is now back above 64.20 and, you know, the Dow put on quite a lot last night. The Footsie there at 91.22.
It's definitely Rachel Reeves, isn't it?
I mean, you could make an argument that weak cable is better for the Footsie, but I don't know. It was all going probably too well. And as I said to you last week, you can pretty much guarantee it will always let you down. So, you know,
that's
I've been a perennial since the COVID days and never really got paid. And yeah, usually if you get long, it turns and doesn't do what you want it to do. If you get short, it'll just squeeze for no reason. And someone will say, oh, it's a huge rotation from tech stocks into UK defence. Is it?
But this, when we the market weak like we did yesterday, right? And some of the names getting absolutely hammered. Park in 1977 saying Legal and General got smashed. They've got a big gilt position. When you see the currency drop 1.3% and you see the Footsie down, you know you've got real domestic problems. Because, as you say, that should have cushioned the blow yesterday.
Correct.
And the Footsie should have been down 40 basis points. Nah. There's some real selling. SSE down.
Your old favourite.
Yeah, down to £16 now. That one's taken a real beating. So it was. It's a bit depressing. Is it all inevitable? Is this bond market route going to continue? And okay, maybe we get a little bit of recovery somewhere.
Yeah.
Right. But is it inevitable that US 5 and the UK is in a bit of a mess?
Yeah, I think it is. But there's been there's been this continual shift, hasn't there, between the actual economy and the market. And we've seen it here. We've seen it in Germany. You know, all of these sort of indicators that showing you're at all-time high and whatnot. But you speak to the average person on the street, they definitely wouldn't feel like that. So at some stage, it's got to converge, right? So yeah, you would have thought there might be some volatility around the corner, perhaps.
Does she have an option? Because she's backed herself into a corner, hasn't she? She said no VAT increase, no national income tax increase, no national insurance. But at the same point, their welfare reform failed.
Yeah, it failed. So they're not slashing that.
Education.
They're not going to slash that. And, you know, last week we saw the UK banks come off on the fact that she was going to talk about potentially taxing the banks for money that they've got from Bank of England, I believe, or money on deposits or whatever it was.
Which was Farage's policy.
Yeah, I mean, it's obviously trying to do as much as possible without raising taxation, but you've only got so many levers you can pull, right? And if you're not going to stem the spreads, the spend, it's the only thing you can do.
She only needs to find 20 billion. It's a £3 trillion GDP economy, and she needs to find 20 billion. Or I should say, You know, it's not entirely Rachel Reeves' fault. But these, the narrow lane that they've said that they're going to drive down isn't working. It's going to have to be, it's got wealth tax, property tax.
Property tax, what, at the...
Anything I don't have?
At the absolute higher level, or a reasonable level, or... Because they've already seen, what, 16,000 millionaires leave the UK this year, because of taxation and inheritance tax changes and all the bits and pieces, and, you know, the joy that we get of living here, where you've got to, you know, pay stamp duty with taxed money and then receive taxed money if someone dies, which has already been taxed, and you get taxed on that at a higher rate. So I think there's not much more they can do really to sort of kick that area without kicking the much higher area. Maybe it was, I don't know, if you've got 3 million plus house or something, they changed that.
Where are you going to get that money from?
What?
To pay your tax.
Not a problem I've got, I'm afraid. Not yet.
Pete Ward lives in my favourite...
in your head, rent free.
God, with that hairline. Yeah, is it a village or is it a town?
It is a market town, 17,000 inhabitants.
It's beautiful. So I first visited there. I was given a girl a lift to the airport from that I was at, and she said, "Oh, come in for lunch." So went in, met the parents and everything.
Yeah, lovely.
And just fell in love with the place.
Well, you're welcome at any time, Richie.
Yeah. There we go. We got it on film. Perfect. I'll be up on Saturday lunchtime.
That's fine. Sounds good.
So yeah, I think she gets knifed in the back. To be honest, I think they're now going to set her up they'll start saying, right, it was Rachel's decision as Chancellor to promise no increases in VAT or income tax. Mm-hmm. I then think they'll force her into increasing them, and then she bites the bullet and goes for it. Yeah. So they get away with it. They say, sorry, that was all Rachel from account, unfortunately.
Yeah.
And
I still always laugh at that. There was a picture going around that was, it was, you know, when she unfortunately broke down in the House of Commons. There's a picture of her sort of weeping, but on a £20 note. So that was very funny, but cruel. Now, that would be her legacy, wouldn't it?
A picture that does worry me somewhat is the one that we're getting out of China from yesterday.
Yeah, a bit of tension there going on. Basically, which I guess is always the option.
But he does have two friends, doesn't he?
He does.
Not a trio that you would really want to.
It's kind of like when you see the naughty boys at school, isn't it? Like walking down the locker room, you're like,
we know you were one of them, weren't you?
In the middle.
Yeah, you were. So yeah, we look.
Yeah. So yeah, what is it? It's the 80th celebration piece, etc., etc. So they release doves, they do all this sort of stuff. They show all the military strength, which obviously drones, China's got, tanks. You know, all that. So I'm sure they don't show half of what they've got. They show the, and then big Kim Jong-un there, and his daughter, which apparently was significant, sat behind him, and also 2015, which I believe Merkel and Blair were there for, and obviously neither UK or Germany were there, I don't think, this time around. But yeah, Trump was saying on Truth Social, you guys, say hi to Putin and Kim for me, as you conspire against
the United States of America.
Yeah, basically.
This is the worrying one. It says the PLA would resolutely safeguard national sovereignty, unity, and territorial integrity, which still has the plan to go for Taiwan. The great rejuvenation of the
not that much, I don't think.
Okay.
I mean, that's probably a line that's going to come back and burn me in like 6 months' time, all-out war. But no, I think it's posturing. I mean, you know, if the other side worried about everything Trump said, he'd never get anything done. So it's just show of strength. I mean, what is the ultimate show of strength? It's the military thing. You know, North Korea do it as well. You see it on the TV, you go, okay, yeah, they've got lots of stuff over there. Kind of leave them alone a bit. Yeah. And you know, the US could do one equally, if not bigger, with all the jets and all the stuff that they see. You see all those stats, don't you? What one country has versus the other, and the US is like all the way up here. So
huge.
Yeah, exactly. So I don't know. It's gameplay. And then the next thing, you know, next week or soon, he's got a meeting with Xi, and they're talking about their trade tariffs and negotiations. Trump.
Okay.
Yeah, coming up, I think. And there'll be high five meeting ever, greatest game of golf, what a guy. And yeah, on we go. Circus continues.
Okay, well, let's certainly hope so. Right, coming up after the break, we're going to talk about Ashted, that Andrew McKelvey has mentioned on the chat there.
Switzerland.
Watches of Switzerland, exactly.
It's easy for you to say.
Guys, timing is perfect. Right, but what is the chart of the day, I hear you ask? What country are we from today? It's a US stock. So here we go. Let's get ready. Counting down. 3, 2, 1.
She whispers. The truth. Step by step. Red, a candle fine. You lead me up, you pull me down. You wear a bull's face, then turn around. Guess the chart, mi amor. Is it pain or is it profit I'm dancing for? With every tick I roll your side, raise glass, devours my soul. Producer Phil plays coy, he shrugs, while Rich is hedging all his plugs. But Ange, she sees, she knows the game. She whispered and lit the flame. A gap, a silent fall, a fib retracement, or none at all. The RSI is on the brink, but I can't move. I dare not blink. Guess the chart. Is it pain or is it profit I'm dancing for? With every tick I lose control. Your sideways glance devours my soul. Guess the chart. Take the lead. It's love or ruin in every feed. No safety net. No promised land, just broken dreams in a trader's hand. And when the candles black, I'll wait for you to pull me back. A tango cruel, a chart, a chance, forever locked in this deadly dance.
Welcome back, everybody. Oh, a little bit of an awkward moment. I was coming back into the studio and we have a weight holding the door open, and I kicked the weight out the way and told the guys, watch the weight. And Pete got offended.
Takes more than that to get me offended.
Go on then, 8 a.m. Ring that bell, Pete Ward. Oh, we got a bit of strength. We got a bit of strength in WPP of all things. Run us through what you're seeing there, Pete Ward.
So we are seeing, a little bit of a snapback in a few little things there. Nothing major though. Lloyd's still under 80p. Obviously, we've seen that well above 80, 83, 84 recently. BAT's still strong. So nothing, nothing too crazy there. Key ones I think to look for basis results is Ashtead.
Yes, right. Let's just get the losers first, and then we'll go through.
Okay, so again, nothing too crazy there either, is there?
No biggies on the open this morning. A relatively flat start for the Footsie. Right, going to results, sir.
Results-wise, you've got the Q1 results. Their revenue beat estimate 2.8 billion versus 2.78 billion. They are showing as small up, trading 54.25, reaffirmed their full year guidance. And so they are basically. You've then got BP. They've been raised by Morgan Stanley to weight with a price target of £4.
Okay. Equal weight, neutral, £4 target, down 10%.
That's it. Get off Morgan Stanley.
I love that the stock goes up. A bank comes out and said, these are worth £4, and it goes up to £4.37.
Well, it shows no one's listening to that analyst. But we've also got Legal & General, completed a £500 million buyback. They have been doing well since April. I think they got down to 207. Come up nicely, and then yesterday.
So Poppy did correct me. Legal & General have a big credit book. Not just gilts they've got there. It is a big credit book that is the that pain, but real pain at M&G.
M&G, so they've had their first half results. Operating profit there, 378 million. Estimate was 405, so slight miss there. They were called down 1% before the market opened, and they are now down 2%.
And that's after a bad day yesterday as well.
Has the Footsie started to turn and catch up with its US counterparts? Ish.
The land of our European friends. Oh, we've got some strength in Adidas there. I almost bought a pair yesterday.
Yeah?
I went into the office and I'm looking for a brown pair of shoes to wear with, now that we've got the studio and everybody can see my...
Yeah, see your feet. Yeah, I put my best boots on again.
Oh, well done.
Yeah, I thought when you said you bought a pair, you bought Adidas and sold Nike.
No.
That's your usual sort of shopping around.
It is. Yeah. That's as the.
I'm going to invest in something, but I'm also going to take the opposite side of it just in case and go nowhere.
Risk management.
Yeah.
You go long a call and short a put.
Texas hedge. Long both sides, baby. To the moon.
For people that haven't heard of a Texas hedge before, run through because that is.
It's a phrase I came across years ago. But Texas hedge, where you are long both sides. So you might be long the underlying and also long calls.
Yeah.
And someone say, you've got a hedge strategy. Say, no, it's the Texas hedge. Double bullish.
So that's me in gold at the moment. I'm long calls and long the underlying.
Lovely. Whoa, it's been on a rip.
Let's just focus on Europe for a second. So ASML showing some strength after the weakness yesterday. ABB, another one. LVMH, certainly more strength in Europe than there is in the Footsie.
And then, just looking at themes in the 250. Watches of Switzerland, we mentioned it earlier. That was very much a COVID back in the day. Everyone using their welfare checks to buy Rolexes. Now it kind of had a bit of a wobble. Look at that. Great chart. A big good one for Guess the Chart. Well, not now, but so basically they've come out with on track for the year, don't see material impact, and guidance pretty much in line with what they're expecting.
So do we think that's up?
Do we what?
Because it's not open yet. Do we think that's because it's in a volatility auction on the way up?
Let me check for you 1 second. My level 2. is open here. One second.
Supersonic telling us Adidas got a broker upgrade this morning from Jefferies, and JP Morgan downgraded Puma. That's
Watches Switzerland indication up 9%.
Is it really?
349.2, uncrossing in 55,000 shares. Any minute now, actually.
We should. Let's
a lot
watch
of
that one.
going on here.
Any minute now. Oh god, he's
That's it.
gets
Just
better by
on
the
the face of
second.
it. Looks all right. Right.
There
What
it
else
is.
Moving.
There's 350.
We love to see it. Straight up.
Let's take that.
351.60, 353.60. Going strong. And then what else in there? Hilton Foods down a little bit. And that's about it, really. UK. Best of AIM. We got anything interesting there? Not really, to be honest. Naked Wines.
Oh, God, that's an old one.
Yeah, for the boozers amongst us.
That was a play during
They
COVID.
put their trading continued out to be in line. Nothing.
Are they?
Yeah, very much so.
That was a great one during COVID.
Yeah.
My friend managed to pivot from owning a dating app
Yeah.
to owning a wine delivery app in 2019.
Okay.
Right? Like 10x on his revenues. And so I him and seen how crazy busy he was, I thought this thing must be having a roaring time as well. So I bought some of them, and look at that move that we had. So I got them at, oh my goodness, I got those at £2. Yeah, March 2020.
Wowza.
No, it must have been £3.
Good move.
Must have been £3. And right up to 8, and now they're down 90%.
Did you sell them?
Yeah, thank goodness. So I think I sold them at £4, took them from, that was it.
Lovely.
But that's, it's the same as
HelloFresh. HelloFresh, yeah.
Yeah, so HelloFresh.
I don't know. I mean, have you done them before? I've done them. They're fun for a bit, and then you just get sick of it.
Yeah, exactly same chart.
But
look at that.
That's then your business model, isn't it?
Yeah.
But you're reliant on. Oh, let's give this a go. But I don't know. I'm not sold. But yeah, speaking of sold, where's the market? Let's have a look here.
Yours.
We are 91.25 at 26, so we're flat in the. Quick look at where cable's trading now. 133.1. So continuing from yesterday. 133.51 ish. So for the eagle-eyed amongst you, I would say you want to look and see if we break through that level. It could give you a little bit more of a kind of confirmation that test go a little bit lower.
Yeah, 132. Do we think?
Maybe. I mean, uncertainty's the best thing for a sell-off, and I think at the moment with the upcoming budget and sort of the amount of press that there is about the UK government and all the problems that they've got, whether it's on one hand or two hands or to finance things or whatever.
Yeah.
It's just generally a pretty unpopular bunch at the moment. And with it at sort of 135 and holding, and everyone kind of still scratching their head.
Did they need to do a complete change? If they came out and even went down the austerity route, if you saw
You can't really, can you, as a Labour government? Can you do that? Can you be the austerity? You can't. That's the whole. They've been elected on the fact that they hated the Conservative austerity, and that was their whole mandate. So.
repackage it, call it something else. Disciplined.
Yeah, well, it's just basic. But it's a hard one to
Or
get elected on.
incentivize work. I mean, that would be a good start.
Yeah, I mean, a novel idea, but go to work,
Imagine.
earn your money, pay tax. Yeah, good. Whitehall.
We'll give them a call. We'll go past the Bank of England, sort things there, and then we'll go up to Westminster.
Perfect. Yeah, we'll be done by lunch.
Right, good stuff. That the spotlight this morning we're seeing. Let's just have a quick look at oil. So I did put a bit of a short oil on yesterday. 65 for me just seems a little bit. It's had a good run. Let's quickly take a look at that chart on oil. You know, considering down at 63, it felt a bit rubbish. Yeah, down to 62 it got to.
Yeah.
I don't know if I...
Very range for such a volatile product.
Yeah.
What, so you think here is too high?
I just don't think there's too much more. So, you know, it's a small position. I'm like £2 a point or $2.
Mm-hmm.
So I fancy we're more likely to touch 60 than we are 70.
Okay.
If that makes sense.
Yeah. Interesting.
Yeah, but it's not a big conviction move.
And that would be what basis? What, oversupply?
The Saudis. I think the Saudis have done a deal with the US to continually increase output and to you know, to keep oil low. And at the same time, the US is doing the deal with Saudi over AI and everything like that. So so it's a, you know, it's not helping the rest of OPEC plus, especially the Kazakhstanians.
Right.
But it certainly helps America.
That's it.
Yeah, low oil.
Drill, baby, drill.
Right, we haven't had a look at the newspapers this morning, apart from our trio of the Naughty Club.
The Naughty Club, yeah.
So we're getting Poppy just saying interesting. Starmer is revisiting the fiscal savings agenda. So I assume this one, cut spending to fix UK public finance.
Yeah.
By investors.
Let's have a look. 1 second.
Yeah. Well, we'll find that one for you and show you after the break. It is 8:12 a.m. We sent a guess of the chart out, and then because you and I didn't guess it, we didn't even tell them what the right answer was.
My guess was Disney, which was wrong, I think.
Mm-hmm.
What was the right answer?
What is the right
Did
answer?
someone get it?
Alibaba.
There we go. Screamed higher the other day.
About 15% in this. So Alibaba was the chart. But we're going to go for a quick break and come back to you. If you're looking for flexible ways to trade financial markets, whether you're experienced or new to trading, you've come to the right place. CFDs let you speculate on the price of financial instruments like shares, indices, forex, and commodities without actually owning them. You can benefit from both rising and falling prices across 17,000 markets, letting you find opportunity. So if you think the market's going up, you buy. If you think it's going to go down, you sell. When trading CFDs, you're trading on leverage. Now, leverage lets you trade bigger positions with less money up front. So this increases your profits on your trades, but also remember your losses are also amplified. So be sure to manage your risk. With us, you're not alone. You're part of a wide community of traders that you can learn from. We've got the experts, the tools, and extensive educational resources to help you on your journey. If you're not quite ready to trade CFDs with real money, you can always give it a go on a demo account. Open an account today, join the conversation, and be inspired to make moves.
Watch Trade Live with IG weekdays from 7:30 a.m. on our brand new YouTube channel at Trade Live with IG.
As well as the live show on our new YouTube, you will find our full beginner's course to trading options, daily YouTube shorts of all the action that happens after the show's finished, and Trade of the Week and Psychology of Markets.
And don't forget to hit those like and subscribe buttons for more exclusive trading content.
Do you like the sound of tax-free trading? Well, that's exactly what spread betting enables you to do. This tax-free way of trading lets you speculate on the price of over 17,000 financial instruments, like shares, indices, forex, and commodities, without actually owning them. With spread betting, you benefit from both rising and falling prices, letting you find the perfect opportunity. So if you think the market's going up, you buy. If you think it's going down, then you can sell short. Not only is spread betting exempt from capital gains tax, but it's also commission free. All you pay is the spread. With us, you're not alone. You're part of a wide community of traders that you can learn from. We've got the experts, the tools, and extensive educational resources to help you on your journey. If you're not quite ready to trade with real money, you can always give it a go on a demo account. Open an account today, join the conversation, and be inspired to make moves.
Heading down there.
We welcome back to Fast Markets. We're just talking about a secret dinner arranged on Friday night. So Pete introduced me to fellow clients.
Secret. This was back when you were just a lowly trader.
Well, tell
Or
everybody.
I got you a job and made a man of you.
Yeah. Funded my account.
Look at him now with his own backdrop.
Yeah. Just another brick in the wall.
Nice, I like it.
Now, tell everybody how we first met. What was our first eye-to-eye? Love at first sight.
First eye to eye was the long room dinner at Lord's. Invited you to the IG Premium Client Christmas Bash.
That's right.
Which was December of 2022, I want to say.
Yeah.
You turned up in a suit, which you just got at a charity shop on the King's Road. And if you're going to get a suit from a charity shop, well, I mean, the King's Road. It looked like a tailor-made suit. I mean, it fitted perfectly.
Charity shops on the King's Road do some really nice suits. Probably some old died and they just given the clothes, but
maybe.
He was, well heeled.
But yeah. And then from that, you got introduced to a couple of other of my clients and a few other clients that were there. And then you created or you were invited into a
WhatsApp group.
A WhatsApp group, yeah.
So the WhatsApp group, we discuss ideas, we chat. There's nobody from IG on there. There's a few ex-IG, but there's no nobody there. So it's purely clients, and a dinner was arranged. I almost said I arranged the dinner. It wasn't me.
Nothing to do with you.
And as far as I knew, Pete didn't even know about it. Pete wasn't invited.
I was invited. Thank you very much.
Somebody had to pay the bill.
I think that's probably true too.
So big shout out to everybody in the WhatsApp group that are going to dinner on Friday. Now, Fast Markets, sir.
Yes, sir.
We've had big moves since numbers. So I actually want to revisit Nvidia and just do a little sense check of did your numbers were bad, not good enough? Had the stock run too high into it? You know, why on this week?
Well, I don't know. The focus, I mean, you can look back to what we were talking about in the shows and what you guys were talking about with Andrew and whatnot, and it was all very much like, the options, the implied move is same GDP as the whole country somewhere.
Yeah.
And there's a lot of noise, right? And then the numbers came out and they were okay. They weren't blockbusting and it came down a little bit. Kind of almost how you'd expect a company of that size probably to perform on numbers, which is wildly different to what we've seen in the past, which is 25% gaps. You know, when it first had that crazy number. bucks. I think it moved something ridiculous. And I think you become conditioned to expecting that sort of thing. But yeah, robust things which are kind of unknowns, I suppose, with regards to China, whether they make these chips, whether they can't, data warehouses, all these different sort of bits and pieces. But yeah, strong.
If anything, it was the guidance with China that had to be omitted because he didn't have any visibility on it that caused the disappointment. Otherwise, numbers were actually really good. So I'm fairly happy with where we are in this. The 160, no, short some 175 calls actually, but got paid a good premium for that. And then short some 160s. But I'm also short calls at 190. So I think it just trades 170 to 190.
Yeah. I mean, if you're a technical trader, you'd be looking at if you're looking at mapping the bottom end of those candles, you'd say it has now broken through the channel support and could leg down a little bit. But if you believe in the AI story and that realistically this is very much the beginning, then that's the best horse in town, isn't it?
It's definitely, and it still will be the best horse in town. It's just that there are other races to look at. And one of those races is certainly the one that last night and this morning. Look at the recovery in this thing. That's where the Nvidia money is going.
Yeah, that's interesting, isn't it?
Yeah, and it's been, Piers has certainly been pushing this one. The forgotten Mag 7, the forgotten one of the Mag 7, this and Apple.
What's the relative size of this to Nvidia? Do you know?
Very good question. Let's Google search. KitKat of
one on the other.
Google. Well, James has just said in my ear that other browsers are available, but apparently not after last night. It's just Chrome.
That's it.
Alphabet's market cap approximately 2.6 trillion.
Okay.
So I doubt that includes the 7% move. So we're talking about approaching 3 trillion. That's quite big. It's bigger than I thought.
Yeah.
So we've got that, and then we've got Apple. Which one would you rather own? Because of course Apple benefited last night as well, rallying higher. But yeah, that chart's a bit more confusing.
And Nvidia's 4.15 trillion, just for context.
Yeah.
So yeah.
So 50% bigger than Google.
Yeah.
Nvidia is.
And Apple's has got the weight, humongous buybacks, pushing it higher, albeit with, you could say, slightly tired product creation.
Yeah, tired product creation, but will they do a deal in AI which suddenly propels them?
Yeah, or are they making something in-house that we don't yet know about?
But I think they're trying to, but they keep losing staff. Yeah.
Tricky one.
So tricky. Right. What about UK names? What are you looking at, sir?
What about Rolls-Royce? I mean, I know that's been on a phenomenal tear ever since the lows of the 60, 70p or whatever. But it's, do you think it's topped out?
It feels that way.
And would you invest in this as a defensive play like you would sort of BAE and all that sort of stuff, or did you look at it more as their sort of prestige, the name, that sort of thing?
It's funny, it actually looks like Nvidia there.
Yeah, true. But yeah, it's one that's, I think if anyone's still, a lower, well, first of all, well done.
Yeah.
Second of all, you'd probably be taking out 80%, leaving 20 as a runner.
Well, yeah,
it goes.
Yeah, I remember your position's now 10 times the size of the position that you took in the first place.
Exactly, yeah.
Or 5 times the size.
So yeah, you could always maintain what you originally had and go back to that. Take it out and look for the next one, I suppose. I mean, I think investors become blinkered if they have something like that. They go, oh, well, every single investment I've got to do is go to 10x. Well, it doesn't really, does it?
No,
you take on a time frame basis, you take 5-10% in. Do that successfully, you'll make money.
Yeah.
But yeah, I think great to see stocks like that, perform like that, especially in the UK, because it shows that the US that has stocks that can grow like that there is
reassuring.
Is huge. So yeah, what about IAG? I know that was one that was heavily followed by our client base. It really started to take off nicely. £5.20, all this sort of stuff. It's been in a range. It hasn't really gone much higher than kind of 380, 390, down to £3 again. But yeah, there's price targets there calling for what, £5 RBC, £4.70 at Bernstein. Passenger numbers are up.
Yeah.
People are seemingly going on holiday a lot.
I would say,
yeah,
call this
definitely,
one.
yeah.
There are certain solid names in the Footsie, isn't it? It's Rolls-Royce. This year has become your real positions of strength.
Yeah.
Pillars.
In an index which you'd already regard as being pretty defensive anyway, because of the lack of tech and AI in there.
Right, Right, so it is time to take a quick break, followed by our gold guru. Has it got much more upside? I fancy the answer might be yes. Welcome to the new studio.
Yeah, lovely.
Yeah.
Nice. Feels a bit more roomy.
Well, yeah. And your head doesn't look as big on the camera as it usually does.
Thanks, buddy.
Right, we'll see you after the break. If you're looking for flexible ways to trade financial markets, whether you're experienced or new to trading, you've come to the right place. CFDs let you speculate on the price of financial instruments like shares, indices, forex, and commodities without actually owning them. You can benefit from both rising and falling prices across 17,000 markets, letting you find the perfect opportunity. So if you think the market's going up, you buy. If you think it's going to go down, you sell. When trading CFDs, you're trading on leverage. Now, leverage lets you trade bigger positions, money up front. So this increases trades, but also remember your losses are also amplified. So be sure to manage your risk. With us, you're not alone. You're part of a wide community of traders that you can learn from. We've got the experts, the tools, and extensive educational resources to help you on your journey. If you're not quite ready to trade CFDs with real money, you can always give it a go on a demo account. Open an account today, join the conversation, and be inspired to make moves.
Watch with IG weekdays from 7:30 a.m. on our brand new YouTube channel at Trade Live with IG.
As well as the live show on our new YouTube, you will find our full beginner's course to trading options, daily YouTube shorts of all the action that happens after the show is finished, and Trade of the Week and Psychology of Markets.
And don't forget to hit those like and subscribe buttons for more exclusive trading content.
Do you like the sound of tax-free trading? Well, that's exactly what spread betting enables you to do. This tax-free way of trading lets you speculate on the price of over 17,000 financial instruments like shares, indices, forex, and commodities without actually owning them. With spread betting, you can benefit from both rising and falling prices, letting you find the perfect opportunity. So if you think the market's going up, you buy. If you think it's going down, then you can sell short. Not only is spread betting exempt from capital gains tax, but it's also commission-free. All you pay is the spread. With us, you're not alone. You're part of a wide community of traders that you can learn from. We've got the experts, the tools, and extensive educational resources to help you on your journey. If you're not quite ready to trade with real money, you can always give it a go on a demo account. Open an account today, join the conversation, and be inspired to make moves. If you're looking for flexible ways to trade financial markets, whether you're experienced or new to trading, you've come to the right place. CFDs let you speculate on the price of financial instruments like shares, indices, forex, and commodities without actually owning them. You can benefit from both rising and falling prices across letting you find the perfect opportunity. So if you think the market's going up, you buy. If you think it's going to go down, you sell. When trading CFDs, you're trading on leverage. Now, leverage lets you trade bigger positions with less money up front. So this increases your profits on your trades, but also remember your losses are also amplified. So be sure to manage your risk. With us, you're not alone. You're part of a wide community of traders that you can learn from. We've got the experts, the tools, and extensive educational resources to help you on your journey. If you're not quite ready to trade CFDs with real money, you can always give it a go on a demo account. Open an account today, join the conversation, and be inspired to make moves.
Okay guys, before I teach you how to use this, I have to teach you how to use this. The mind. The cash return wasn't all about speed, it wasn't always about power, it was about become the bull. Visualize greatness. Okay, minds are ready, time to go. Hey, come on Pat. Cash returns, come on. Oi! Oh, you're not going to get better than cash return.
Hello, I'm Axel Rudolph, Senior Technical Analyst at IG and Fellow of the Society of Technical Analysts with over 30 years experience in trading the financial markets. I've been following cryptocurrencies from the very beginning, and with IG's new crypto offering, I can finally share my technical analysis expertise on crypto with you. So join me every Wednesday morning show, Charting Crypto, where I'll be answering your technical analysis questions on all things crypto live.
friends, welcome to the Gold Hour with Copper. How are you?
Great to be here. Very well. Gold's still going that way. So.
I know. It seems to like time nicely with whenever I get you to come in.
It's, yeah, I mean, I was saying earlier, the direction of travel with gold is pretty clear. Speed of travel less clear, but gold is had a fantastic time, and I don't see any reason for the party to stop. So yeah, exciting times.
Exciting times. Well, let's have a look at the price, shall we? Because it is certainly one to behold here. We have seen it much higher and broken past that, of course, that 3,530. Right now, 3,536. Still strong green candles there. And you heard me say this yesterday, looking at technical. So we break above that 3,506. Then perhaps that area of interest, that 300, 502 range is in sight. And we have, of course, blown past that as well. And it seems like all of the mood music is pointing towards higher prices. But I guess the question is, for how long?
Yeah, I mean, it's a very good question. I mean, what I love about the situation at the moment is not only do we have the technicals pointing up, but the fundamentals as well. So we've got double bubble, so to speak. And so how long? Many things that I often go on about: market uncertainty, interest rates, debt and inflation. Those fundamentals are definitely sort of in place, and the technicals as well. So yeah, I don't see any reason for there could be volatility, and I don't think it's a necessarily a short-term trade willing to sit on your money for a few months. But if you're prepared to do that, it does look like gold, could do very well for you.
The other question from some of our trader friends over the last day or so is we've got the possibility now, of course, real possibility of a Fed that is likely to cut rates even more. The first cut expected to your mind, is that already baked in?
Yeah, I mean, the first decision I think is the 17th of September, and I think that the market is expecting, in my view, about a 25 basis point cut, and I think a lot of that is in the price. So if we get it, then obviously you get the certainty, and I'd expect the gold price to flip up. But if we get anything more than 25 basis points, I think the gold price could really take off. And if they hold rate, it would be no surprise to me if it sort of goes down. So, but I think all the indications are that they'll be cutting rates. They like to sort of telegraph these things to the market. So yeah, I think if they cut rates, yes, good for gold. Will it go mental? Probably not. But yeah, I think it'll be a good day for holders of gold.
Great. We'll get questions from the chat when the gallery put up the chat on the screen in front of me in just a second. At the moment, it's just a blank black screen. We're still. What do you think about our new studio? We're still having some teething issues.
It's very stylish, isn't it? Very stylish indeed.
Does it not look?
It looks a lot bigger. No, it's really
still the same size, of course.
It's very nice indeed. It's but yeah, no, I think new CEO and new investors in gold, hopefully.
Let's have a look at silver now, because we've been talking about this a lot as well. And the last time you were here, that I was waiting on silver because it tends to lag gold. And lo and behold, whilst you and I were away last week, I was anyway, it breached 40.
You need to remember silver, its previous high was, I think, north of 50. Not much north of 50, but north of 50. And it's now 40 odd. and so it's still some way below previous highs. And going back to what I said about gold, very clearly your graph shows that. But if you're prepared to sort of take a longer term view on silver, a few months, and try not to look at it every day because the price really does jump around, it could do incredibly well. But yeah, it's not for the faint-hearted because it is very volatile.
I mean, this is the interesting thing too about silver and gold, right? We've seen them. I'm going to show you the monthly view now, trader friends, because this is very volatile, but it has had a really impressive run. Some down there in the last quarter, but also, I mean, taking a look at gold, just really, really impressive run, year to date. And we're still heading higher. Calls by different houses, your JP Morgans, your Goldman Sachs, that we could potentially see maybe 3,700 or even higher. Middle of next year.
Kind of forecasts. I think the key really is the volatility, and the price can go up a lot, but it can also go down a lot. So, if people are going to invest in the sector, and I mean, the thing I love about gold and silver, physical gold, physical silver listed companies, if you've got physical gold or large, medium sort of sized companies, you've got a very liquid investment. If you want the money in your bank account, you can normally get it within a week. But man, they're volatile, and so you do need to kind of accept. And that's one of the reasons why I think it's good to have a bit of diversity. One of the things I love about mining is, you could have a mining company that has found a lot more gold or silver. Their production's gone up, so their share price could actually go up, despite the silver price or the gold price going down. So, when you've got that volatility with gold and silver prices, having some of the miners can actually help you. So, yeah, I think it's good to have a bit of a spread.
Yeah. I've got a position in Kilby chiming in, asking whether you have any views on Greatland Resources.
I love it. I mean, it's. I don't like to talk about particular companies, but I mean, they are, I think, Australia, Tasmania, something like that. But yeah, they. I you need to be careful how it's. Obviously, the top line is going up dramatically with increases in gold and silver prices, but the bottom line is going up as well in terms of the costs, all-in sustainable costs. They used to be around sort of 1,200-1,300. They're now closer to sort of 1,900. So margins are doing pretty well by and large, but yeah, you need to look at both sides of the equation. Look at the costs as well as the revenue, because if you have revenue, you probably get a bit too excited.
And a great call too from Andrew and Greatland, because there, this is the weekly and showing you the monthly as well, so you can see that big, huge gain there in the month of June. A lot of chatter around volumes. Thank you so much, all of you that have been following us as we unveil our new studio and helping us with the testing. So we're having Maturin saying volume fine for me. DW saying that volume is way too low. DW try and twiddle with not just the YouTube volume, but also the desktop, or your laptop volume as well. It was low yesterday. We did tweak it, and we we're fine tuning it as well.
Actually, while you talk about volume, I thought you were
Thank
talking.
you.
I thought you were talking about the volume in terms of the number of
Oh,
shares traded.
No, so you.
Okay, but no, but that's actually very relevant to what you're doing, because a lot of these companies, and when you look at them, you know, someone says, "Oh, buy great," but and suggest you buy it on the exchange with the greatest volume,
Yes.
which means the most shares traded. Because if you do that and you decide to sell, obviously any sale is a willing buyer, willing seller, and with higher volume, you've got more chances of executing at the market price. If you go to one of the smaller, well, not so much a smaller exchange, but an exchange where less of the shares are traded, the volumes are lower, you may want to be selling your shares, but you may struggle to find a buyer. And that's when the market price could be, let's say, a pound, and they can't find any buyers at a pound. They can only find a buyer at, let's say, 90p, and suddenly, bang, you've lost 10p.
Yeah.
So yeah, volume is important when you're buying shares.
Volume is king. Now, speaking of volume, I also want to ask you about ETFs. Many of our friends here, asking very often, and should we look at, ETFs if we don't? Big fan of not going down the ETF route, right? Just explain.
ETFs, they have a place, don't get me wrong, but I think that if you're looking for diversity, I would say, why don't you just buy a fund? There's some big funds out there, BlackRock and Jupiter and things like that. They've got big funds. If you're just looking to have exposure to the gold price, that's when it can be good. But if you want exposure to gold, then why don't you just buy the physical? Now, I know people say, oh, well, you've got storage and insurance costs, but an ETF's got those if it's backed by gold. And I think the thing with an ETF is there's lots of links in the chain to form an ETF. You've got different roles within an ETF. Basically, your adage, you're only as strong as the weakest link. And so if you buy an ETF and there's a problem with one of the links, there's a de facto problem with the ETF. And a lot of people are buying gold, not necessarily for some Armageddon protection, but they're buying it perhaps, let's say, as a safe haven in case there is a problem in the financial system. And so what you need to be careful of is, especially with ETFs, is that you are actually solving the problem you want to solve. If you want to just get exposure to gold price, it can be fantastic, and they're very low cost. But if you're looking for other reasons, then you need to make sure that the product that you is suited to the reasons you want it for, if you know what I mean.
Yeah. Interestingly enough, just taking a look at the ETF space here as well, whilst we have many of the junior gold miners ETFs as well, starting to monitoring the ETFs. And I get what you mean, because rather, underperforming or channel, what I call stuck in a channel for some time. Of course, now that gold has really skyrocketed, they're all starting to follow suit as well. But back to sort of macro news as well. Those of us with positions in, gold or the actual miners itself, what should we be taking before this Friday's job number?
It's difficult because the job number, you're talking about non-farm payroll,
yes.
That kind of links into interest rates. You're kind of making a double assumption if you're not careful, because if the job number is weak, which it could well be, then cut. But what you need to be very careful of is that numbers are quite often revised quite significantly from the number that's announced, and the revision, which you need to kind of keep your eye on, rather than the number that's announced. So Do I expect any shocks with the non-farm payroll numbers? Not really. I think the number will be weak. If it's particularly strong, I think the market will potentially go, okay, we'll take a bit off the gold price, but let's to 2. People are like, well, actually, that's what I thought it was going to be. But it's the revised number that people need to really be sort of careful of and keep an eye on.
Yeah, especially with all the mood music surrounding the validity of the numbers these days.
Well, exactly, yeah. I mean, there's a lot of sort of conjecture about that. So that's why I think interest rates, I like them as my kind of, I don't know, go-to number, because you can't mess around with an interest rate. It's either this or it's that.
Yeah.
Whereas you can't, with a farm payroll, you can revise the number. You can't go and revise an interest rate.
Yeah. Jonathan Aylward, good morning to you. I don't think we've met before, but he's chimed in. If you haven't got a view, not to worry. I'm just going to bring this up because I do like this chart. You're asking about before, but look at this chart. What a beauty there. This is the monthly view, and I'm going to show you the weekly as well. See that nice little big turn there, and that almost doji there, which then showed a kick in and volume up there on the weekly chart, similar there on the daily as well. What a move there. Empire Metals, this is a company that is in, I believe, in titanium, if I'm right in saying that, and it has this Pitfield project in Western Australia. Am I right on that, talking about titanium? Yes, high purity titanium dioxide. Is this one that you've come across?
I have focus on gold and silver, but one thing I'd say about the juniors is, I mean, you can see what happens when they get it right. But you do need a spread. Getting it right are pretty slim. But if you've got lots of different positions, you only need one to take off, and quite honestly, you don't care about the others. And so I think that juniors are, they're a lot of fun. You can make a lot. I think that I would view them as more speculation rather than investment, if you see what I mean. It's, if you get one right, well done. But it goes from a speculation to an investment at that point. But if you're with what I do, I use the gold program system, where I use fantasy football format, and I have big companies as goalkeepers, large-ish as defenders, medium-sized midfielders, and have my explorers. And I always say to people, look, it's good to have a bit of fun, but you can't play football with 9 forwards. You've got to have some others. The whole idea is to make money. And so yes, when you get it right, I mean, I'm not sure if you've got WA1 resources on there. You can look at it last year, went absolutely mental. I think you made, I can't remember how much you made, but multiples of your money.
Like that, WA1?
WA1 resources.
I don't think I have that here.
You don't have it, okay. Yeah. But I mean, it's like, you can make huge amounts of money if you get it right. But yeah, you need a spread, because obviously they don't all work. It's unlikely one will go bust, but obviously that can happen. They can run out of money. But I think it's good to have a blend of sort of less risky and higher risky, and then you put them together, and you kind of get a decent return, but then you've got your kind of your high risk stuff in your back pocket, and if something happens there.
Fantastic analogy,
exciting.
Especially since football in play right now.
Exactly.
Yeah.
So, but yeah, I mean that's I use the same format for gold, and it's a simple way to explain, how you can try and make a lot of money from gold.
Just very quickly, because we need to wrap now, but very, very nice. Someone kind of now looking, towards the end of the year, how should they be positioned? What sort of percentage mixture should you have in your portfolio if you wanted, obviously exposure to gold, but also platinum and silver?
Yeah, I mean, giving percentages is very difficult. I mean, what it is, I wouldn't go all in on gold and ignore silver and platinum, or all in on silver and ignore gold and platinum. I think it's good to have a blend of all three. I'd probably have more money in gold than silver, and certainly more money in silver than platinum. So, but yeah, I mean, a lot depends on how much money people have got and they want to invest in the sector, but like all three. And if you've got all three, and as we said earlier, you can cope with the volatility, providing your money in that you don't need to spend anytime soon, then yeah, you could have a lot of fun.
Nice. Thank you very much, Simon, for coming in. And any questions there that I also look for and pass on to you. So if you want to send me any questions, bang them here, or also if you can slam the like and subscribe button, because that's what helps us get you the lovely Simon Popple here every time, and also this wonderful new studio. No expense spared. We're also lobbying for makeup. I know I need it. Not Simon.
I certainly need it.
On that note, we have got investing all sessions before investing experiences. So stay right there.
If you're looking for flexible ways to trade financial markets, whether you're experienced or new to trading, you've come to the right place. CFDs let you speculate on the price of financial instruments like shares, indices, forex, and commodities without actually owning them. You can benefit from both rising and falling prices across 17,000 markets. So if you think the market's going up, you buy. If you think it's going to go down, you sell. When trading CFDs, you're trading on leverage. Now, leverage lets you trade bigger positions with less money up front. So this increases your profits on your trades, but also remember you're also amplified. So be sure to manage your. With us, you're not alone. You're part of a wide community of traders that you can learn from. We've got the experts, the tools, and extensive educational resources to help you on your journey. If you're not quite ready to trade CFDs with real money, you can always give it a go on a demo account. Open an account today, join the conversation, and be inspired to make moves.
Watch Trade Live with IG weekly 7:30 a.m. on our brand new YouTube channel at Trade Live.
As well as the live show on our new YouTube, you will find our full beginner's course to trading options, daily YouTube shorts of all the action that happens after the show's finished, and Trade of the Week and Psychology of Markets.
And don't forget to hit those like and subscribe buttons for more exclusive trading content.
Hey, welcome back to all sessions and
Right on the bell.
Yeah, 1 more minute to go. Ooh, here we are.
We're there.
We're there. Shaking up, and we have got here are the losers first.
So, no, Alphabet up 5.7%. So, on the news from winning that antitrust vote, Google up 5.7. Apple also benefit from that, up 2.5%, but not as high as they were yesterday. Touched 239 in the aftermarket. What are you seeing on the losers on the day, Ange?
There's lots of losers there. Let's see, it's shaking. Top of the losers list, they're down more than 3%. It was, I think, yesterday quite heavily as well. Block down 0.75%. JD.com down and GM, General Motors, heading lower, 0.7%.
297, but Ange, the bond yield Well, Ange will see you tomorrow.
I will.
I'm off duty.
Number 9.
There we go. Well, I'll see you. Welcome to the Investing Episode 8, brought to you by IG, the global investment platform. Now, since we last spoke, big things in the world, when big things happen, we get the smart people in the room to debate them. However, unfortunately, I couldn't find those smart people. So, as always, we are stuck with CJ Fillingham and Mark Spice Holden. Now, as we're going to bring you the key on your portfolio construction and all those questions you've been saying, we're going to get. So we're going to have a debate as you would expect to see happen in an investment committee. That's right, a fly on the wall in today's big investment committee debate. However, before we get to that, we go straight to the Spice Market Update.
Thank you, Rich. As you've alluded to, it's been a really interesting week. But let's start with the fact that Jackson Hole was actually positive, and that's driven the S&P 500, the world's big market, to a new all-time high.
No cheers.
That's great. Got a cheer there. I know you guys are, sort of anti-US markets.
No,
I'm positive markets.
We own 20% of US stocks in our portfolio. So
Exactly. So we come right to the end of the reporting season. One of the big companies to report last night is a company called Snowflake. And this is a company with shares were up 15% yesterday. And this is a company that is basically adopting AI for clients. It's basically helping them analyze their data, optimizing the outcomes, and using AI to do that. So it shows this next, the evolution of the revolution is also beginning to happen now, which is positive. But going right to the heart of the AI revolution, we know Nvidia had results last night, but in the guidance, which slightly disappointed a few people, although it increased 2%, they've taken out all of their future guidance about China. Now, optimists will say that a full year or the next few years, that could generate as much as $50 billion of revenue. Now, when you're making a 75% gross margin, and that's a huge amount of potential profitability out of the forward guidance, to the tune of about $38 billion. That's huge. And so the shares having down about 7 or 8% this morning are trading just down 1.5%. We'll see how they end the day in America when they start trading properly. Other big events this week, we've seen political, and it looks like the minority government is going to be out of work again very shortly. There's a confidence vote on the 8th of September, and it looks like the incumbent government is going to lose, and we're going to have to go through a whole reshuffle. Now, that's led the French stock market, what's called the CAC 40, to fall about 3%. And that's purely down to this political uncertainty. Politics don't really influence stock markets very much, but when they do in specific areas, they can have this little effect. So 3% stock market and a little bit off. Their bond yields have risen. Their prices have gone down against other big bonds in Europe, like Germany. The spread, what's called the difference between what the French government have to pay to borrow money and the German government have to pay to borrow money, has widened. Going to pay more.
this is a over the next situation, not unlike the Brits, not unlike the Americans even, where they're spending huge amounts of money in the public sector on new investment, new infrastructure. The tax revenues that are coming in cover them, have to and have suggested that in order to do this, Sacre Blanc, which would not go down well with our French friends, they want to also public spending. The minority government is not going to get that through, and as Mark says, is it likely to fail? And then they will move on, try to shuffle the deck chairs again.
Away from that, the only other sort of thing which has been the main events really has been that there's been a sort of an increase in tensions again in the US on the trade front. So basically the Chinese have said to their companies who want to use AI chips not to, if possible, buy them from the United States. They're trying to avoid buying chips from the United States. Maybe one of the reasons Nvidia took that out of their guidance. But nevertheless, that's what they're guiding to. And actually, the Chinese stock market and the Hong Kong having
You think that positive or potentially positives that came out of Jackson Hole, are those outweighed by what went on with the question over Federal Reserve independence? Mark, what do you think on that?
Well, I think, as you say, one, as long as there's nothing really stupid that goes on with and this is basically Trump trying to influence the people going onto it in the coming months and year so that he can have more influence, supposedly. But these people are going to be chosen because they might think more along his lines than the current. But nevertheless, that could be positive for equities as well.
And clearly that's an optimistic view from our resident Dove. Perhaps it might be wise just to talk about on the Federal Reserve Board, 12 people who vote on the Federal Market Committee.
Okay, and that's the FOMC.
And that on the board, 3 at the moment were appointed by Donald Trump.
Right.
If he manages to Mark's view, naturally optimistic in life as an equity guy, economy and do the right thing. A cynical old git, as you have to be if you trade bonds all your life, is an important, a little bit of background. US in the because I want to just give a little bit of background to, for those who don't know Donald Trump's developer. And in New York or down the Eastern Seaboard, casinos or whatever, and setting them up as businesses in their own right, leaving them up very high with debt, and the real estate developer, he lower interest rates.
Right.
Because if he gets lower interest rates, the debt costs less. A bit out the middle.
So that's why he's so obsessed with it.
Should go lower. For 7 banks. Seven have gone bankrupt. And why it's have gone up, made these numbers not add, basically handed the keys back then to the banks and said, banks, your problem, not mine, and moved away. So he loved lower interest rates. And he behaves to me in the very same way that private equity, they gear up balance sheets, pay money, interest rates go up, you lose a lot of money because it's clear where he wants it to go. And if people wanted to be cynical, you could argue this is all part of a right view is at the moment. People will do the right thing, but the worry will be in the back of the head. And what does that mean? Let's bank works because as people are making decisions are independent of the political process. Generally, people think they're making decisions for the right reasons to keep inflation down. And so the bond market says, I have comfort. Long-term inflation will be low. The right decisions will be, and therefore I'm happy to buy long terms. That long end bond yields, least of all the Americans. So bond yields, as we've talked before, that's why this is important.
So in a nutshell, first of all, he really went for Jay Powell, didn't he? And he said, no, you can't do that. Scott said, there's no way you were sacking the chairman of the Fed. But then his little opportunity to whether he could fire her with, if he manages to fire Lisa Cook, he appoints. He's got a majority in that votes for the other local governors. And then officially the independence is lost, but he's got a fair sway in the way that interest rate policy is made going forward. Mark, that's got to worry you more than a 25 basis point cut, Jackson Hole.
Well, they're not just picking, people out. They're putting forward. There's a guy called Kevin Haslett. He's currently the National Economic Council Director. So he knows what he's talking about. He are more monetarists who believe stay high until inflation comes down. It's actually you can let inflation go up a bit because that's not going to damage the economy if you keep it relatively under control. But they all think then the people who are advocating interest rate cuts at the moment are advocating it because they think inflation is getting high and then will trend lower months. As long as the data supports that, then cutting interest rates now will be a positive. That is a very powerful thing. Chris Waller is already on the FOMC, well-respected member, but the only people asking for an interest rate cut at the moment. But fraternity and investment banking and investors around the world. There's another guy called Kevin Waugh, and he's formerly he sat on the Fed. So these people, he's not picking his mates down the pub or sort of his golf courses. These are guys who are well respected, but they have the same view of monetary policy. And personally, I do as well. Economies to do well, you need a bit of inflation. The thing that central banks fear the most is deflation. So prices drop rather than go up a little bit each year, because then, people defer purchasing decisions. Why would I buy something today if I think it's going to be cheaper tomorrow? You wouldn't. It's illogical. So you defer your decision to make that purchase, and that begins to hurt the economy. Whenever you hear the word deflation or disinflation, central bankers panic. which is, by the way, why Japan had such a difficult time for 40 years. They had deflation. People weren't spending any money because it'd be cheaper tomorrow. Now, if you think the price might be a bit higher tomorrow, what you go and do? You go and buy it. So you start that helps the economy. So a bit of inflation is good. And we've pointed out before that the best asset in a vaguely inflationary environment, and remember inflation is averaged about 3% over the last 100 years, are equities. If you a 6.5% plus real return, that's over and above inflation. So they're giving you about 10% against 3% that you get inflation. And the next best one's bonds, and then cash is the worst one, which we've talked about before. That only matches inflation. So I think these guys, you can't just say because these guys, they're idiots. They're not. They're very well sort of respected people. They just happen to have a different policy outlook.
Okay, so I think you've taken the debate to what the crux of the argument is. Do we think that inflation is going higher?
A bond person is going to say, well, you say a little bit of inflation. Well, what's a little bit? And when it becomes a little bit more, and when it's a little more, one could argue that the Federal Reserve were too slow in raising interest rates, which caused them for Biden when and so there's your point. So if the bond market feels that every excuse is going to be used to say, we believe in this way of doing things, and if it's wrong, we'll just leave it for a bit and say it's transitory and whatever, the bond market won't like it. So the problem for me is that if we go down this route, and I'm with Mark to a degree, most of these people are sensible people, they have sensible policies, they have sensible thoughts. But if the market starts to worry that the risk is one way, the risk is that inflation will be a little higher, and so sells markets, it's possible that the new FOMC won't cut interest rates like they want because they have to earn.
Okay.
So there's an argument both ways here, but it comes down to this: how much inflation is good and how much isn't. With Mark, I think one of the issues we've had over many, many years, Europe certainly, is we've had too much of a focus on 2% or just slightly 2%, below 2% inflation, which has stopped the growth coming through to the degree that it could have done. And it's certainly happened in the UK as well. Now, at the end of the day, we could have said, well, maybe, when I say less than 2%, by the way, I mean that was the target of the central. Is the question, and we're going to see the answer to this unfold in front of our eyes. But the risk, I think, will have to go higher if Donald Trump carries on. And I don't think Mark would disagree with me on that. I think we both say the risk premium is going to go higher. The key judge will be if inflation stays low, it won't be a problem. But if inflation starts pushing up a little bit and the Fed don't react because they all believe in this dove, that
we're getting to a really interesting in the next 12 to 18 months because the benefits of AI are going to start coming through. Now that gives us disinflation, which is great. So maybe that does take us back to the target, and dare I say it, Trump is right. However, at the same time as giving us disinflation, does it take jobs, move unemployment rate higher, 4.5, 5? So it could be in a world with 3% interest rates, 4% inflation. That scenario, Mark.
Well, I think you've forgotten one big thing, the one big, beautiful bill.
Oh, it's so
See?
it's beautiful.
So
Absolutely beautiful.
as a counter to your AI, the younger people in the tech industry coming through, there is the one bill coming through, which means economy that is doing that and goes on to what, the impact of Jackson Hole. But when you have an economy that's growing at a reasonable rate, inflation is under control, and interest rates are falling, typically stock markets have fantastic. And I was looking back over the last 5 we've had 3 of that, and basically 500 has risen over 30% in every single one of those years. The average has been a 35% rise in the S&P 500, NASDAQ 40% on average in years where you have this combination, which I think we're going into, which is why I'm so positive.
Now, is there any part of the stock market specifically that does well? We're fully loaded on these mining stocks, copper, and commodities overall. Environment, health, commodities.
So last Friday at Jackson Hole, remember the Jackson Hole Symposium, the chairman of the Federal Reserve, Jerome Powell, spoke, and he actually surprised people by being more. In other words, he was now more in favour of cutting interest rates, mainly because he sees unemployment possibly rising in the US, and that's one of their mandates as the Federal Reserve, so unemployment doesn't rise too much. So he was concerned more than he is about the possible inflation sort of coming through. So he's moved into the camp that says now we are probably going to cut interest rates. This is really good news for the economy. We on the 1st of September 2017, next week.
Came out, market moved to discount 5 interest rate cuts in the next year. The chairman sits down. To me, the pricing that was in the market already. So my view is it wasn't bad news. Me, what the market had already sniffed out and told you was going to happen, rate cuts, was going to be delivered. I suppose that's better to know it's not going to happen, but by the market in the way it did. S&P 500 is trading within really did what with the Fed. What is going on with the Jackson Hole speech?
Sorry, I'm going to have to issue the yellow. We are here, model portfolio. I debates on the two are first in the portfolio at the moment. Spice, do you think that
uncertainty that is and equity by having the way for Jerome Powell talking about now accepting that there'll be interest rate cuts. That's in a way a major uncertainty. If you believe like me, you've got the benefit have this combination coming. And as I said, If we get into a position where interest rates are falling, economic okay, inflation is okay.
I am more the political risk that's coming in than I am motivated by the Federal Reserve Chairman's speeches. We've had a view that we're holding 20% cash in the portfolio because August and September are traditionally difficult. Personally, therefore, why wouldn't we stick with our strategy? Now, what I want to do is get action and think to your plan, cool, calm of the day. I am not arguing that we should reduce, hold off, buy, get through opportunity, hopefully in September. How it expects.
Okay.
So to me, the way I've always run my asset allocation committees is if somebody really wants to do something, just as vociferously, we're experts. We know our stuff. Mark is an equity expert. You're an expert in the commodities. I'm an expert in the bonds, allegedly. For me, that's enough if we decide that's the right thing. So I suppose I sum up the conversation as saying we've had a good tool. Do we want to make any changes? Does anybody do something today? Go to you first, Ray. Seen happening
12 to 18 months down the road is that two problems with it, with potentially from over leads to, if I was looking at negative financial crisis, if I was looking to it positively, a boom time of that could be something that's done over to keep a good us to consider a move over the coming weeks, but not necessarily today.
Now, what
a red
card.
That's because you. I'll give you the option yet again.
I felt strong enough. I didn't. Can happen in the next 18 months. Strongly enough to do something now. Yes or
do well as well. Silver is much more exposed to the industrial side of the economy, unlike gold, which doesn't really get used much in industry. It does. And it tends to do better when the economy is doing well, there's a bit of inflation around, and gold is doing okay. In that, silver can do a bit better. But the biggest problem we have is as a portfolio, there with about 20% in one form or another.
Fund Manager 2.0. Please.
So I suppose, thing is if I were to go more to want to buy silver,
With gold as well.
yes.
You wouldn't want any more than 20% in the metals area, or in that sort of
I think in that metals area.
buying some gold. Because if my risk to my portfolio is slower growth and things,
To banks and borrow money. So when interest rates coming down, their interests come down, their profits go. Russell, great way to play this environment that I think we're going to. But 10% in are respectful of this that we've talked about before. So I would put 5% into the Russell.
Okay. So on the table then is a increase in our US equity currently have, which is the Russell 2000. Chairman, what do you think?
I said earlier, this is not a democracy. We go with the experts when we feel. I've got no reason to do some rough gold, but given expertise, timing of that second selling percent then of our gilt holding, our iShares 0 to 5 year, to fund it.
Then we are increasing our weighting to equities, and we're doing that by taking 5%, as we like to think of it, our cash pile, and buying the Russell 2000. Now, speaking of that portfolio, I must admit, I was a cheer as I saw asset markets go higher after Jackson Hole last Friday. Run us through the performance.
Rose pretty much what we'd lost the last week for. So we're back to being up 0.59% so far. And in the last week have been led by the crypto and blockchain ETF, which has it was up 5.8%, which is really good, which since we bought it originally, it's now up over 7%. The second was the BlackRock World Mining Fund, and that was up by 1.98%, let's call it 2%. So it's beginning to show some signs of improvement. And the next best was NASDAQ 100.
Oh, there it is.
There you go. Now, the worst performers was actually, ironically, the best for us the previous week. So India was up about the week before last. This week, it gave back about 2.25%. The next worst performer was the German DAX, maybe affected by some of that political talked about in France, just being on the edge of there. And Japan, having taken out all-time highs recently, gave a little bit of profit taking and was down just over 1%. But overall, a good week for our portfolio. And we're now up 0.59% since we started the portfolio in total.
So great. Well, I promised that we would answer some of your questions that you've about portfolio construction, about portfolio management. It's time. Let's dive straight and go for what I think is my favorite question. What are the top factors that when looking to build a portfolio over the next 5 years? CJ, I'm going to come to you first on that one.
You can answer this You can talk construction, you can talk about macro factors. Construction. First thing I would looking to build that for the next 5 years at least is there's been so much focus on. The tariffs being a perfect example of that. And I think that's going to lead to more volatility than we've seen for a long time.
Wow.
So I think you need to look very carefully at what exposure is. Just an example, if you hold the world equity index at the moment, is dollar exposure. So we've talked just now about the great prospects for the US equity market, which we all subscribe to. What about the dollar? It's a big factor in there.
Yeah.
And people have got to remember that. So that's the second point. The third point is the final point that we talked about just now, which is think about some diversification to protect you from system risk. We have at the moment, there's too many to name, but there's Trump, there's what's happening in there's all these things going on. And you get the feeling the world is getting a bit more of a dangerous, and there's more trouble around. Bitcoin exposure in our portfolio and the portfolio are great protectors against things going against central view and against the current norm. So for me, those would be the three things I would think about.
Excellent.
I would add there, if you risk that the US dollar, if I'm reading between the lines there, you think the US dollar, principally because of Trump and the debt, etc., in the US might be weaker than some of the other main currencies. That has played into a really good performance for commodity, led by normally because it's seen as a bit of inflation safe haven and as well in times of systematic risk. But other commodities tend to do as well if the economy itself is doing okay, but the dollar commodity, and we've got lots of lovely exposure to that.
We have 20% of our number in those types of assets.
Yeah.
And that is a good chunk to protect ourselves if things go a bit awry.
Insurance policy.
Correct.
Now, seeing as we've touched on currencies there, I'm going to go to a question that we've had in regarding a Vanguard 500 UCITS ETF being held in GBP. Now, the same dollar ETF is now above its high from the start of the year to those January highs. Is it to do with the exchange rate, Mark?
It's totally to do with the exchange rate, Rich. Let's just imagine you're going on Heathrow and you think, I haven't got any foreign currency. I'm going to America. I need to buy some dollars. So you get your wallet out and you spend £100 buying dollars. And let's say you did that on January the 1st this year. That would buy you about $130, give or take, for your £100. So that's great. But you go on holiday and guess what? You've used your credit card, you haven't used the cash that you got, and you come back sort of 6 months later or 9 months later, and you come sort of customs and change that money back. And believe it or not, these foreign exchange companies are doing a great deal. They don't charge you any commission, please. So you basically take your $130 back, but because the exchange has changed, the amount you get back in pounds has changed also. Now, in this, the dollar's gone down, so the value of that. And in pounds, you only get £96.30 back. And if you imagine that's buying the US stock market, the S&P 500, holding it in US dollar terms, when it the UK, if the pound has gone up, but the dollar's, then you'll lose a bit of money that side.
Yeah. And it emphasizes how important it is to know what your currency exposure is.
That's where it came. Well, my second point just a minute. Think about that exposure. You can buy ETFs. You will see one of S&P. So we're protected against those currency moves on the S&P 500. So people need to think about what currency underlying exposure they have, and if they're comfortable with it. You can look for other ETFs which hedge. Questions yourself. And I'd love to be able to make it for you. It took me 40 years to learn what my skills are and what my faults are. And I still make those same mistakes now, but just hopefully less. I would like, though, to point you all in the direction of a book, which I first read in 2016. It tells the story of a funds of fund manager. Now, basically, in the city, that's somebody who's running money for people, but rather than directly investing in securities, he's buying funds.
Right, so that's a fund of funds.
So that's a fund of funds. And because he was very successful, he was able to get access to all the best fund managers. And he wrote a book on the lessons that he learned about how they run their positions, how they cut their losses. Art of Execution. Very similar to our title, fun enough. And it's by Lee Freeman Shaw. And he describes investors into a number of different categories. Now, I don't want to spoil your understanding, but we will do a podcast on this in a few months' time. He divides people into, we all start off as rabbits, by the way, when you do this, the assassins, raiders, connoisseur. I don't know what you are yet.
Well, just as well, because the was just...
It's a wonderful book. I would say you will learn so much about where your problems lie and where and how.
If you presume we're talking about a global equity ETF rather than a balanced things, if we're looking purely at the MSCI Global, 72.5% of exposed to the United and I've been persuaded to listen to your view on these. So we have the cheaper market. Talked about this before. Our third biggest holding is the United Kingdom, the Footsie 100.
Yeah. Yay!
Now, unfortunately, with 3.6% in the Footsie 100.
Enough.
Some people's signs. And we haven't not necessarily looking at forward performance. job as investors is to think about what's going to happen and how to position best for
sidelines waiting for an opportunity. And asking the question also is in a similar situation with recently started an interest rate of 4% on cash in their ISA account. Would that be if they move some of it into the markets? Maybe when you get your salary or at specific points of the month.
dollar. That £2 a month into your pension or into your ISA, then that's probably a good way to do it. And over a long period of time, you'll get some. On average, over that period of time, you should get it to market. Than just pure cash. It's a portfolio. And actually, if the markets did have a slip and you had this opportunity to buy a gilt portfolio, value could go up in capital value.
Right.
Because it would extend. Bond prices go up, the yields go down, and therefore we'd get an extra kicker maybe in performance with that capital. So yes, we're not getting as much on those gilts as we would do by putting it in IG's hands in the cash, IG paying you for.
And he wants to know, in the event the market were to drop significantly, like what do you guys do in 2008 and other similar markets, whether it's 87 or the dot-com crash? How do you know when's the right time to cut, or when you just want to ride out and
08 crisis, the great credit crunch, seeing companies like Lehman's go bust was the most shocking thing I think I've ever experienced in my life. And there was seemingly no way to stop what was a downward spiral in asset prices. Banks weren't lending. Central bankers were stepping back. Governments were letting companies like Lehman Brothers go bust, letting Rock go bust in the UK. Bankruptcy and had to be government. That was the most scary thing. Was we were with deflationary spiral. No one was lending. It was a proper credit crunch. But the central banks, and they marched over the hill to rescue the Federal Reserve in America, who there's yes, we've let bust, but now we're going to stand. Is saying no, this is too painful. That is the time to do it with hindsight. And I wish I hadn't done it, but I have worked with Chris at a time now. I'm sure an example soon. But
and COVID. COVID out of the blue, nobody knows that's coming. Suddenly, oh my God, markets are falling, growth is going to be terrible, blah, 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 blah. Corporate bonds, which remember are fixed income instruments guaranteed by. So they're these things are trading terribly. In fact, they're not trading. They've gone illiquid and they won't trade. Remember the afternoon? Absolutely couldn't trade at all. Suddenly, the Federal Reserve comes out and says, we stand behind the corporate bond market. We will against the corporate bond market, full face. That was the turning point. I turned to Mark and a couple of our colleagues who said, this is buy every equity you can.
This is it.
And that was, I think, 2000, if I remember rightly, on the S&P 500, might be 2100, 2000. It was just fantastic. Now, I turned on it, which means when I've made a bit of money, I get out.
Yeah.
Rather than being the connoisseur who stays in it and makes an absolute killing.
Yeah. Well, I now know what I am as well. Now that you've described what a is, then I think I am guilty of that, unfortunately. As these moments really ever it takes. And that was the moment. Market didn't read when
another example, when he introduced QE infinity. If you remember, he said QE and we're never stopping until it works. Well, you knew then what was going to happen.
There's a great saying, don't and the Federal Reserve have the most respect of investors around the world. The reason people didn't latch on Mario Draghi so early is the European Central Bank are not liking equities, and they've never really stood the market.
Now, excellent. A very quick question on entry costs. What entry costs should I consider and how do they impact returns of a portfolio? To are commission, stamp charge. Okay, now, thankfully with IG, it is commission-free to buy your investments in your SIP, your ISA, and your GIA. Also, in the portfolio, then those are not charged stamp duty. So that's also bonus, no commission, no stamp duty. And in the UK, there is, of course, depends on how much you're a very good start. There's no commission, no stamp duty.
Do is they don't charge you stamp duty, share purchase. Small investors.
Right, excellent. That is unfortunately all we've got time for today. We've taken as many questions as we can. There are some, unfortunately, that will be unanswered. However, we will to you in written form in the next week to make sure that we are bringing the answers to you from our experts. Gentlemen, thank you very much. Now, of course, it's not. We will take questions in future weeks as well. If our viewers have any questions to email in, where should they email?
The art of investing at IG.com.
I think it gets better by the week. All the best, everybody. Good luck to you in your investing. Give us a follow. Give us if you've particularly enjoyed today's podcast. Make sure you tell your friends all about it. See you next week.
Stocks were down, surging here after hours. It's Tuesday, September 2nd, 2025. This is Overtime. I'm your host, Chris Vecchio in New York, Ilya Spivak in San Francisco, Dylan Radigan in Milan. The three of us back together to take you through the rest of this hour. Futures market closes at 5 Eastern, 4 Central. If you're on the platform, Tasty Trade, on the website, tastylive.com. Welcome. Tell us what you're trading today. Did you buy the dip? Did you get all bared up and think that the end was nigh simply because it's September? S&P 500 only down by 0.5%, now 64.40 here in the after hours. Mark the close at 64.25, so the bounce continues, off by nearly 1.5% in the NASDAQ, now only down by 0.44. It's that indigestion after the end of summer. Volumes are finally back. 1.7 million contracts traded in the S&P 500 today, which is pretty nice if you can get it. Bond yield, the curve twists, but ultimately Treasury's a touch weaker. Is Trump alive or dead? Is China, Russia, Iran forming a new trifecta, a new alliance?
Yes.
Cool. Gold prices surged to a new all-time high. Silver prices have a nice day for themselves as well. Finally, we take a look at crude oil, which is bouncing. New geopolitical regime coming into play. Dollar firm, which is perhaps the most notable assessment of this all. Gold, silver, and oil up on a day when yields in the US dollar are pining higher. In any event, gentlemen, what was looking like a pretty ugly start to September, only about 3.6 Rutgens. Not great, not terrible. Dylan, hats off to you last week, by the way. Saw those interviews that you had with Guy Adami and Bill Fleckenstein. Very nice. I'd encourage everyone to go back and watch last Wednesday and Thursday's episodes if you haven't had a chance.
Thank you for lending me the real estate for the discussions. I appreciate it.
It was
great discussions.
Difficult, trust me. I was sitting by the pool and I was saying, this hurts. I can't believe I have to do this to let Dylan have the real estate, but I will do what's necessary for the company.
Ilya allowed me the real estate and he was generous. You were lazy and God knows what you were doing.
It was so terrible to do no heavy lifting, but merely to consume these interviews with a nice cup of coffee and a lean back in the chair.
Yeah. Well, yeah, that was great. Hopefully we'll do a few more of them. There's lots of folks we can rope in, I'm sure.
Looking forward to it. But for now, you're stuck with the two of us, Dylan. So let's just start here. Stocks off the lows. Meek Mills is starting an AI company, but your response to that information was, of course, just to buy them up. So are we buying them up here in a spooky September?
Yes, absolutely. Yes. Take advantage of the dip. Call your friends, call your uncle, call your aunt. Get some money wherever. Go look under the couch. Get in there and get after it, my friends. This is everything that you're going to get. All this spook is going to just open the doors to glory. So make your shopping list. Number one on my list, Google, by the way. I'm now a mad Google lover. Gone full Googler. But anyway, yours.
We'll get to the individual equities in a second here, but Ilya, this Monday reversal in stocks, there's some damage. It's a bounce from the 50-day moving average in both ES and NQ. Mm-hmm. Is this the market doing what it did in August, where it sold off around a weak non-farm payrolls report? Are we positioning for a weak jobs report on Friday and getting it out of the way now?
I mean, maybe. Certainly, this is the first of September that the markets get to have, at least on Wall Street, that the markets get to have a cash equity open. So there's probably some laying out of positioning for the month. Lately, and this is a weather vein I check often, the comments in my YouTube have been, oh, well, markets are always down in August and September. Well, they weren't down in August, and over the past 10 years, it's about 50-50. So I wouldn't necessarily say that this is seasonality again and again and again, but September is historically a weaker month on average. Obviously, it depends when you take the average. If it's a 20-year average, yeah. If it's a 10-year average, less so. So it varies, but we are starting a new month, and there is seemingly a desire to reposition here. Now, is it for the non-farm payrolls report? Doubtful. The sort of dynamics we've seen really since mid-August, and if you want to go even earlier, really the beginning of August. We start August with, oh my God, these meta earnings are incredible. And they fade. And of course, leading into that, the Magnificent Six, excluding Nvidia, fade. Then we get into August. CPI gives us...
Is Meta going down because of their earnings, or because we found out that they have a chatbot that talks about sex with underage kids?
Well, that was later. That was later.
It feels materially important.
Meta surged 12% in a day on those earnings, and the markets couldn't make hay of it. It's not like the market didn't like the earnings. It loved the earnings. And the market couldn't make hay of it. For that matter, they couldn't make hay of Amazon or Google or Tesla or any of the other Magnificent Six. They faded all of them. Then the markets faded CPI after one day of gains. Then they faded Jackson Hole after one day of gains. Last week, they faded Nvidia after one day of gains on Friday. And we'll see what they do this week. But the dynamics seem to have been the markets. It's like that Simpsons episode with the flying pig. They get one piece of data or one piece of news and go, it's just a little airborne. It's still good. It's still good. And that's for one day. And then they can't make hay of anything else. There's no follow through. There's no trend development. We keep getting stuck. It's as though we can survive a piece of event risk, unless it's objectively awful, and we haven't seen one of those since the last jobs report. And outside of that, the markets go, oh, well, this could have been worse. And you get one day of rally. But if you look at, nothing has really gone anywhere. The S&P 500 hasn't really gone anywhere. The NASDAQ hasn't really gone anywhere for the better part of a month. So chances are we're looking at this jobs report and going, okay, well, we'll either survive it or we don't. But do we really have a reaction function here beyond a day? Maybe not.
Dylan, looking back on some of the data for the month of August, it was a record month for zero DTE options trading, where on a daily basis, we averaged 2.4 million contracts a day, which makes up now 62.4% of overall SPX volume. It's basically an even split between retail traders and institutions, though retail traders have the edge with about 53% of that volume. What does it say to you, generally speaking, about the market overall and the health of the market when we are increasingly short-term focused? Is this making us more fragile or anti-fragile, as Nassim Taleb might put it?
You're asking me?
I am asking you.
Yeah, we are anti-fragile. I mean, there's no question. The market has trained the world to buy the dip at a level that I've never seen before. I mean, the amount of destruction that is required in the sell-off for it not to provoke immediate dip buying has to be so big so that any sort of surface weakness, 1%, 2%, 3% sell-offs, I mean, the level of resilience just from sentiment. I mean, so it's going to take a real trend of inflation data, not just a one hot number, but like an ongoing trend, or some sort of real, major change in economic policy, like we saw in April with Trump, and even that was short-lived. But absent some real material exogenous force in the labor market, in inflation expectations, or in basic economic structure for the United States. And without one of those three things, I mean, not just happening one bad number, one bad comment, one big miss, whatever, but a pattern therein or thereof, every single time this thing backs off, it's a buying opportunity. And that's something I would not have, a younger, stupider version of myself who was subject to thought and thinking would not have said this. But now that I'm older and think less, I offer my opinion very clearly, which is buy them when this thing goes. You buy them. I mean, I don't know how a man like Ilya, to his credit, maintains a healthy level of skepticism and has all sorts of thought-based rationale. But good luck to you.
Well, one of the more remarkable things about today's market, if we're going to think about the seasonality, and we'll go into that momentarily, it's how gold and silver held up and rallied so significantly throughout the course of the day. Even as equities reverse off their lows, the bid in the safe havens, so to speak, doesn't drop or fall away. So gold here now up at 35.99.5. Thinner markets after hours. It's not the spot market, but nonetheless, the push higher continues. There's a really interesting note out from Dr. Data for today's cherry picks. I'd encourage people to go check that out. But is gold a safe haven in the market? He looked at a study showing the various thresholds, decline thresholds in the S&P 500. So over the past 3 years, when gold's, when the S&P 500 has been down by, 1% or more, gold's only been up 36% of the time. So gold and stocks have by and large traded together for the most part. If stocks are down big, gold's going to be down big.
This is my favorite thing to poo-poo over the years. This idea that gold is some kind of a safe haven.
Safe haven from something specific, not necessarily a sell-off in equities, but something else that's happening in the economy or the market. In any event, it's $3,600 an ounce. This is an all-time closing high here. I was able to take off some gold calls today, which had been struggling mightily for the past several weeks with a few days to expiration. So I'm not going to, look to give horse in the mouth. But Ilya, this seems now like something important is happening if gold's able to do what it did today at the start of September.
Right. I mean, and I've flipped over my position. So I was basically looking to have exposure, short premium, either through calls or puts, depending on where we were on the bounds of this 5-month range. I mean, basically, gold hadn't gone anywhere since second half of April. And if we were near the top of the range, I was selling premium by selling puts or selling calls. And if we were at the bottom, going the other way. So the latest kind of version of this was selling calls near the top, and ultimately, obviously, we've had a breakout here, so I've flipped this over and I'm selling puts again. In fact, the trade managed to run so hard today that it gave me a chance to even make a little money by the close. I'm not going anywhere. This looks like a breakout, but it just speaks to, you wake up here on the West Coast, you go, oh, this thing is probably breaking out. I got to flip over this position before it eats away all the premium that I've received. And thankfully, I was able to get out still in the green and flip it over and make a little bit of money on the other side. That's how much conviction this move had. It's very interesting, by the way, that we get this conviction at a time when the bond market is across the board lower. And you get the sense that the dollar had a great day on haven grounds, not on yield grounds, because the likelihood of a Fed cut in September has only increased. It's 91% now. So all of this now starts to look a little spooky. And you sort of wonder if on the first day of September, everybody went, wait. So we finished August with a Supreme Court case on whether the Fed governor or a Fed governor can be fired by the administration. That's now going to the Supreme Court, most likely, the curious case of Lisa Cook. And then you get, apparently now, the tariffs going to the Supreme Court as well, because you get a court ruling last week saying they're illegal, or at least the tariffs contingent on there being an emergency.
Well, hold on a second. How funny is that, Dylan, that the tariffs were made illegal and the Cantor Fitzgerald boys were selling those contracts about the tariff reimbursements?
Seems like it might have been some kind of it's an odd coincidence, Dr. Vecchio. Peculiar and odd.
Crazy that the Commerce Secretary's former company decided to make markets and insurance for tariffs that would be overturned. Yeah. They're the only company smart enough to do so.
Here's another interesting little tidbit for you that's adjacent. FinViz,
must be a coincidence,
a wonderful data provider, compiles data on insider buying and selling. Because, of course, you have to report these things when people inside companies buy or sell. This data has to be reported lest there be some sort of shenanigans. Well, at the end of last week, the entire board for insider buying and selling was red. Out of 200 transactions, not a one was a buy.
Are you suggesting that there is an internal dialogue within the Trump administration to arrange transactions that are financially beneficial to the individuals involved with the administration of said policies?
I suspect this could be what's going on. I don't want to point fingers.
Okay, we wouldn't want to point fingers.
People are saying.
Well, can we talk about I think the biggest thing, even though I know it's sort of market distant, but I personally I actually believe that the China, Russia, India meeting, which is, well publicized, was actually quite significant. I don't think that was nothing.
Well, can we get into that for a quick second here?
Because I would love to, because I definitely have the opposite side of this perspective.
Of course you do. The Reuters report today said that India has started to sell U.S. treasuries and replacing them with gold in their FX reserves as a response to Trump's tariffs. So we see weakness at the long end of the curve today. You see that gold is going up. Dylan, this India, China, Iran, North Korea realignment. Russia's in there. Why do we care about this? What's the big deal for the global, new world order that's coming?
There's a foreign policy theory that has been around for a hell of a long time, which is that you really just want to keep any sort of adverse counterparties at odds with one another. So as long as the various adverse counterparties are not aligned together, they're grossly ineffective in terms of coordinating anything. And I'm imagining what Ilya's counterpoint to me is, not to try to neutralize him or even speculate as to what your answer might be, is that they're not really going to be capable of working together because they have such divergent interests. However, I do think that they recognize a material opportunity to exploit the apparent fragility of the coherence of American leadership and have an incentive to align in a way that they've never had before. And while they have many issues, they don't have a currency that they can really use. There's no threat to the dollar, obviously, but they do have an incentive to accelerate their trading within the group. In a way, it just accelerates the momentum of the formation of a better organized counterbalance to the United States at a level that I don't think has existed ever in the past. And I think it adds, I think it reflects on the risk of having, such a long history of what I think as incompetent leadership in the United States, going back to Trump 1 through Biden and now Trump 2. You're looking at a decade-ish of, subpar, if not way subpar, leadership in the United States in a way that in the short term is irrelevant, but over time starts to present meaningful opportunity for counterparties. And the most meaningful counterparty in the mix is obviously China. And if China can enroll India in Russia, Russia is less relevant. Obviously, Russia's more optics, in my opinion, and more sort of like historical, like political status, but there's really no.
Well, I mean, they have nukes, so there is that.
They have nukes, but it's a paper tiger, relatively speaking, economically, et cetera. But economically, India and China are not nothing, even though they, even if it's only 5% of the country that is involved in the economy, when your population is 1.4 billion, 5% of the population there is 1/3 of the American population. It's 150 million people, represents 5% of the Chinese or the Indian population, which is nearly half of the number of people in America. And so, again, there's all sorts of reasons why this won't take on the momentum necessarily, but I do believe it is a incremental, but not insignificant negative for the United States.
I mean, I agree with that assessment almost totally. I guess where I am looking at this is at the capability of this alignment. I do think that despite the fact that, for example, India and China don't get along, they do have now a joint interest in exploiting the apparent strategic weakness of decision-making and positioning in the United States in a way that neither one could hope to exploit until relatively recently. And this is a very powerful unifying force. There's no question. I completely agree with Dylan there. Russia is a paper tiger. They can't even manage to win a war against Ukraine. So not exactly the most capable, and economically a tiny fraction of a thing. So not exactly.
But they're window dressed.
But they do have nukes.
And they have the largest landmass, which is a breadbasket for China.
They do. And so, to some extent, yes. What's the most sort of interesting here isn't that the U.S. is so well positioned as to resist a formidable challenge. The U.S. is not well positioned. In fact, that's why the challenge seems to be occurring, because there's been a smelling of blood in the water.
But you're telling me that enraging all of our closest allies and trading partners, and then pushing together all of the people philosophically and economically against us together to work together.
Not a recipe for our strength, no.
That wasn't a good idea.
Well, it's not a recipe for our geostrategic strength. If the recipe was for our geostrategic weakness, then it's succeeding. But not a recipe for geostrategic strength.
Oh, so you kind of triggered me there. Dylan, if the goal here was to push India and China closer together to make our allies less certain in our ability to lead the world, what would Trump be doing differently?
He would never have retracted first. There's a couple things. One, and it's a biggie, even though people didn't think much of it or whatever. I don't know what people thought about it, but the United States' moral position in the world as the beneficent rich uncle providing investment in Africa, investment in South America, for relative pennies, but America's sort of extension of goodwill via minimal but significant educational, healthcare, and infrastructure resources around the world, which Trump has basically come back and withdrawn as much of as possible and said, well, they're not paying for it. If you don't, but
USAID was shut down this weekend completely. State Department killed it. That
function was, I believe, the most persuasive thing that existed for the United States as a moral that it was basically you're paying pennies to have the ability to influence the world. So one, I think the retraction of global goodwill because of the withdrawal of that investment is catastrophic and opens a massive door, especially for China that's already been marching through that door for decades. If you go to the Barbados, all the medical equipment is Chinese. You go to South America, all the medical equipment is Chinese. You go to Africa, all the medical equipment is Chinese. That is just utterly an incredible self-inflicted injury for the United States that's going to be difficult, if not impossible, to recover from. And then the tariffs send a message of, we don't want foreign things coming to our country. We would like to do less business with the rest of the world. And so I would say the commercial signaling is stay out. The social signaling is we don't care about you. And the rhetorical signaling is you're on your own. You look at the J.D. Vance speech, the NATO stuff, all that jazz. And so I think you put together the rhetoric on from the executive branch on international relations with the tariff, with the withdrawal of the goodwill investment. You put those three things together and you basically create an isolationist view of the United States, which ultimately all of North and South America in the scope of the world is basically a frontier backwater. The entirety of the world lives between, London and Beijing. And they look at North and South America like some sort of frontier ranch. And if it wasn't for the US reserve currency and the robustness of the US economy, which is obviously hyper dominant, no one would even care about North and South America. And so doing anything to diminish the relevance of the United States when the United States is the only thing that that balances out the centralization of all power between New Delhi and Beijing is idiotic. And it's very difficult. It's almost impossible to acquire power like that. It takes, world wars and decades and currency games and all this, a lot of things. But once it's gone, you kind of lose it incrementally, and then you lose it all at once. I think what people worry about the dollar, I actually think the dollar will be the last thing to go. Like the dollar won't actually, the dollar won't be the first thing to roll over in the sort of decay of American global relevance. It'll be the last thing to roll over. But
this is where I'll take the other side. Is despite the fact that we're obviously doing things that are telling geostrategic adversaries that we are weak and ripe for a challenge, I think actually we are neither so weak as to be ripe for a challenge, nor so weak as to extrapolate the current episode in the long term. And that's not because we're strong, it's because, to Dylan's point, the major sort of pole of power on this other side is China. And they are not the pole of power that they appeared perhaps before COVID even. because what they don't have at this point is an economic model that works. And without that economic model, they have nothing. So the problem in China, besides the fact that their economy continues to be built on a premise of cheap labor, they have, first of all, an aging population whereby that cheap labor is going away and is not and is no longer cheap. In fact, the population is going away at such a clip as to make their economy basically inoperable demographically before much longer, give it 5 to 10 years. Moreover, they've been in a deflationary state for 2 years running now. And it's, in fact, a bit more. And it's because at this point, there's no demand. So China cannot hazard a conflict with the US because the only way that economy still does anything at all is because it sells things to the US.
So, yeah, they've been in deflation for 2 years.
More. 9 quarters.
3 years. Dylan, the rates of home ownership among Chinese millennials has gone through the roof. Something like 71% of Chinese millennials own their homes. In the United States, that number's less than 35%.
Yep.
So we've avoided deflation.
Well, there's been a housing crisis. Those homes cost nothing, and the government is giving away money so people would buy them, and the economy is still in deflation for 9 quarters.
Sure, but I guess the point is that
What is the point, Chris?
In China, you can change, right? In China, you can change the policies. You can't change the party. In the United States, you can change the parties, but the policies don't change. China aren't they doing a better job addressing some of these things than the United States is that arguably leaves them better positioned for the long term?
No, because they don't have the people to run that economy. There is absolutely nothing about Chinese home ownership that says absolutely anything at all about their ability to
If we continue to pursue our own immigration policies here, will we have the population required to keep the punch bowl filled?
Oh, well, that's a separate thing, and this is exactly what I'm saying. I don't think the challenge is doomed to fail because we're strong. We're weaker than we've been possibly since before World War II in relative standing. But the challenge is insurmountable for a player like China. They're just too far behind. They did not get rich and powerful fast enough. The demographics are stacked against them in a way where the challenge seems doomed to fail. And that's not a statement about our strength. It's a statement about their inadequate firepower for the challenge.
But I do find...
Okay, so they fix things with India.
Sorry, go ahead.
Go ahead.
No, I'm just saying,
No.
you're ignoring India in this entire conversation, which is actually the largest nation on earth. And I know...
Well, that's what I'm saying. So they fix things with India.
Yeah.
Yeah. They get the they maybe get some immigration going on.
Interesting.
On a little ping pong between Delhi and Beijing and Bombay, throw some Tata Motors here and a little
interesting. India is a very interesting layer to all of this. If we are successful in driving India away thoroughly,
we have not.
You could make the argument that China could address their demographic shortcomings by essentially setting up factories in India, and they'll be Chinese run, but in India, and you could maybe see something there.
The Japan model.
India is notoriously incoherent. India has a very hard time actually marshaling all of its resources because of how fractious and difficult their regulatory state is, their politics are, and were you to find some unification there, this would be a different conversation. But at least for the moment, India is very difficult to harness as a single power node.
I mean, I guess the question is Dylan, are you buying India, China, Russia on these news? I can't really buy Russia these days, but when it opens up on the sanctions end, do you buy the foreign equity still? Because China did a lot better than the U.S. did over the summer. China.
I don't think you are. I think politically it's relevant. I think financially the United States is the center of the world and will remain the center of the world for a long time to come. I think that the political shift can be decades before the economic shift.
Yes.
I think the economic shift is the last thing to happen, and it may never happen. But I don't think the economic shift happens early or quickly. I believe it happens later. And I think, if anything, the chart you're showing, if you're going to do anything, own gold.
I totally.
That's
agree.
really where I'm landing on
totally
with this, Dylan.
agree.
Dylan, this is really
totally agree.
We land here because the thesis that we've worked on for the past year and a half, 2 years plus, really going back to October 7th, 2023, right? Gold gets its pop right after non-farm payrolls because of Hamas's attack on Israel. And it really hasn't looked back since then. You sprinkle in the tariffs. Ilya, what have we been saying since April? If you're a country, and why do you have all these US dollars and treasuries to begin with? Because you trade with the United States.
Yep.
You want to recycle your dollars somewhere. And so at the margin, if you see less trade on the horizon, you still need to have something for your reserves. Maybe you're not going to add the dollars, but you're not adding British pounds. You're not adding euros. You're not adding anything else except for gold or Bitcoin at this point in time. And then you get this headline today, India selling treasuries to buy gold for their FX reserves. What more evidence do we need that this is like the predominant theme?
The writing's on the wall. I mean, clearly.
This is still the trade. This is the trade. If you are thinking that India, Russia, this is all a new world order,
if you think that
gold is still the trade.
Right. And my point, I guess, is that you don't have to even think that. I don't think that. I don't think that India and Russia and China can mount a meaningful challenge. I think they'll try. But the very fact that there is a level of speculation and that there is a try and that price action is responding is good enough reason. Because frankly, it doesn't have to be about the meaningfulness of the challenge. The very fact that the US has been so enfeebled internally from the inside out that this challenge is even a point of conversation is enough to say, well, you know what? Let's get some insurance for this is going to have to be a show and prove kind of challenge rather than it's pointless to even attempt this. Why bother? The U.S. is an impregnable fortress. I mean, obviously, the challenge is significant enough that it is being mounted at all. And that already is a reason, and the price action is responding. So I don't think you even have to believe in the validity of the challenge or the capacity for it to be successful to look at gold and go, okay, yeah, we're going to have a speculative period here where this is a thing that we're going to talk about, buy gold, as I did.
One of the problems that's coming up recently is about debts in the developed world. In particular, there have been some really odd movements at the long end of some curves in, say, the UK, or if you look to Spain.
Oh, yeah.
And it's pressuring the currencies now. The British pound was off by 0.87% today. We talk about a world where a lot of these countries are seeing increased deficits. The UK just announced that it's going to be delaying its budget. It has not been transmitted over to Parliament yet, so they're behind schedule. Delaying budget's not going to solve any of the problems, but it's one of those just headlines that like the government just can't get a grip on everything. Ilya, your enthusiasm for the US dollar has been well noted. And yesterday on First Call, you argued that the dollar is still in the middle of a bottoming process as it's been since July. Today gives us that bullish outside engulfing bar, even with all this talk of other countries selling their treasuries to buy gold. What do you take away from the dollar's action here on this Tuesday?
I think one of the most interesting things on the board today is you get yields higher, gold higher, and the dollar higher, because one of these things seems like it's wrong. And gold seems like the odd one out because it really shouldn't be rallying if yields are up and the dollar is up. The fact that it's able to rally in that kind of an environment tells you something about how strong gold is. But then you start to look at this in context and go, well, why are yields rallying? Are yields rallying for some sort of positive economic outcome? Is the dollar rallying for some positive economic outcome? And I think the answer clearly is no. The numbers that we got today, the only thing that we got was the manufacturing ISM. It was disappointing a little bit. It actually ate into the dollar's gains for a spell there until the dollar came back. This is not anything that is ostensibly predicated on there being less of a chance for a Fed rate cut. No, the probabilities for September only firmed up. We're at 91.7% now. So this seemed like risk aversion. And it seemed like the kind of risk aversion that's actually worried about, again, interestingly, sovereign risk in the US, which is how bonds didn't pick up a safe haven bid. Instead, it looked like a rising term premium sent yields higher.
And so then you're saying the dollar was tracking the yield bump? Is that your rationale for the dollar move?
Well, I think the dollar was not up because yields bumped higher for good reasons. If there was good data and a sense, well, maybe the Fed doesn't need to ease as much, then you'd see, yeah, yields are up, dollar is up, but then stocks would be up, and you'd get a general kind of growth positive vibe, and gold would not be doing what it's doing, almost certainly. Instead, bonds sell off because apparently we're injecting a level of uncertainty back into the bond market, and the dollar is gaining as a haven, which is really interesting in this context because it suggests we're not worried about the U.S. sovereign being incoherent. It's not sovereign risk. It's policy uncertainty risk. If it was the U.S. sovereign is being incoherent, we'd see April, late March again, where stocks, bonds, and the dollar go down at the same time. That the dollar is up in this environment is telling you this is not worries about the U.S. becoming a bad borrower, say, or facing a meaningful geopolitical challenge or whatever else. This is about uncertainty. And frankly, these Supreme Court cases and how front and center they've become over the past 24 to 48 hours, that smells like the catalyst du jour here. Any theory is as good as any, but this is not a dollar that's rallying because it's getting yield support. Because that yield support isn't coming from anything growthy. It's coming from a parallel spook. This feels like risk aversion. And you're seeing the dollar capitalize on that really across the board. The yen is down. The Aussie is down, albeit not as bad as it was earlier. Canadian dollar, pound, euro, you name it. Everything across the board.
Are we seeing increased sovereign risk?
I don't think so. The dollar wouldn't be up like this, I think, if we were.
Well, it's certainly not the incoherence that we saw earlier this year. That's right. To your point. I think that makes a ton of sense. But Dylan, there's also a lot of incoherence in this policy still.
Sure.
You're talking about U.S. policy?
I think, yeah, U.S. policy. There's a lot of incoherence.
Incoherence.
All kinds of incoherence.
Incoherence it's like the Marshall Plan directive is incoherent policy, like the modern.
Do you see what Trump tweeted this weekend?
Is the policy.
Incoherence is the mandate. But Ilya's point is that it goes back to the financial crisis. However incoherent American policy is and however degraded American credibility becomes, the thing that keeps America above water on a relative power scale is the even worse condition of its primary rivals.
Yes.
Which one day might not be true, but it's true right now.
Yes. Yes.
Ilya,
both of those things.
How much money do we get? How how much money do we do a year per year in trade? Do you know how much in the United States, in the US?
With who?
Just generally speaking, because I've been trying to wrap my head around this tweet from the White House that Trump's policies have brought $8 trillion in new investment to the US.
What? Where?
Well, that's why you have such an incredulous reaction, because the economy itself, like, we have about, what, $4 trillion in trade total? And so his tariffs have produced $8 trillion in investments in economic activity. Dylan, if they're going to just make up
and a
numbers,
bunch of these investments aren't investments. They're plans to do something over the course of a decade plus.
Yeah. So
this stuff
to
isn't
put this
a
in
done
other
deal
terms,
in the best case.
I mean,
it's like when people
ChatGPT says the total value of all U.S. exports and imports is $7 trillion.
$7 trillion. And so Donald Trump's tariffs in just the past 5 months, because Liberation Day was 5 months ago.
And that's, by the way, imports and exports.
It's incredible. $8 trillion.
Unbelievable.
The nice thing
Dylan,
with basically a pretend presidency is you just say things.
Yeah, I mean, like, if they're going to make up numbers, why not go for something even more ridiculous?
I mean,
5 quadrillion.
A million, billion, jillion.
Okay, so this is exactly the kind of crap that took down the Soviet Union, for what it's worth, and I do need to opine on this.
Yes.
When bad information flows upwards, and people are saying like, "Oh, like, we can't tell the boss the real numbers because that's going to piss him off, and I don't want to get shot in the back of the head, so just tell him what he wants to hear." Decision makers can't make the right decisions because they don't have the actual information that's real in front of them. So I don't know who's feeding Trump this load of crap that the economy has had $8 trillion of investment and benefits from these trade deals thus far. But God save us if that's what he's being fed, because it means he's going to turn stocks are near highs, and we just made $8 trillion since April. Dylan, we can turn that dial a bit higher, can't we?
Absolutely.
Think of all the money we're going to make. How much higher can stocks go?
I mean, I would think they could go up to another billion, trillion more.
Well, speaking of which, Bank of America released their 2027 forecast today, Dylan. Do you think that they see the S&P 500 above or below 9,100 by the end of next September?
Above.
Above, they do. Correct. Good guess. Bank of America sees a 52% rally in the S&P 500 from now through the end of next September. Ilya, when we're printing S&P 500 9,000 hats, what will have happened to get us there? What's that world we're living in where Bank of America is correct? Something which, by the way, if you go over to the S&P 500 options chain right now, you go out to 381 days. We'll go 393 days, in fact, to the end of September. Yeah. And you were to look at 9,000 calls, they are 1 delta. So 1% chance of happening. In theory, we could sell a call spread up there, risk $50 to make 10,000. So why shouldn't we roll the dice, Ilya? With this one delta?
This looks like the kind of call that tells you that when Jensen Huang tells you that the AI boom is just starting, they're taking that statement at face value. Okay. I mean, assuming this wasn't a typo by an intern somewhere at B of A, I think it tells you that magical thinking continues to prevail. One wonders, obviously, where the magical thinking ends, but there's no telling when. I think another interesting kind of tidbit in this story is that we actually now have more ETFs listed than individual shares.
Wow.
In other words, we have more dishes than we do ingredients. We are so out there. Oh, and by the way, just in case that was not enough, there was some wonderful news coming out from the great Jared Dillion. I'm sure folks out there that are paying attention are aware. He's a great writer, former head of ETF trading at Lehman, and writes an excellent newsletter called The Daily Dirt Nap. And he points out that we've just had 21 new applications that Tuttle filed for income blast ETFs that seek to extract
admin.
That seek to extract a options income juice out of basically synthetic long exposure. So
Nice.
you get a synthetic long via long call and short put options, and then weekly you sell the near money put option, and then attempt to extract income from receiving the premium. Now, these 21 ETFs, agentic AI income blast, crypto treasury income blast, meme stock income blast, robotics income blast.
Dylan, these are all the things that we want to see.
Are we not in a bubble?
We're getting okay. Well, the actual report here. So I use 9100 as the line in the sand, but for the sake of shock value as we go out the show, the actual Bank of America forecast says the S&P 500 hitting a peak of 9,914 in September 27. What's their rationale, folks? This is why they earn the big bucks. In the last 100 years, the average gain among 14 bull markets has been 177% over 59 months. And based on that data, because stocks are only up about 80% since the October 22 lows, to get to the average return of 177% over 59 months, they'd have to see the S&P go up to 14 by September 2027. So that's why we're going higher, because history demands it. That's as bad of a rationale as any. But you know what? Overtime's out of time for today. We'll be back tomorrow, same time, same place. As always, 4 p.m. Eastern, 3 Central, right after last call. So for Ilya Spivak in San Francisco, Dylan Radigan in Milan, I've been Chris Vecchio in New York. Good luck trading. Brief break. More Tasty Live after this. Ilya's here with Macro Money. See you there.
See you there, everybody. Are stock markets finally feeling a bit weak-kneed? That's what we're going to be asking today on Macro Money. I'm Ilya Spivak, head of Global Macro here at Tasty Live. And we've had some interesting price action here in these financial markets over the past 2 sessions. Friday, soggy. Today, the weakness continues. And when we start to look at what seems to be the catalyst, the situation gets ever more interesting, because putting a finger on something decidedly negative is not the easiest of missions. It's not like we got an unequivocally bad piece of economic data last week. It's not like we have a situation where there is a situation with the earnings or the geopolitical front where things are going in the wrong direction. But nevertheless, we seem to have the most potent 2 days of selling that we've seen since late March, which was, of course, that lead-in into Liberation Day and the bloodletting that followed. So what we're going to do is we're going to take a look at what seems to be at work here as much as we can make it out, and then take a look at what is expected in the days ahead to give us a little bit more clarity about where things may be going. So first and foremost, let's take a look at how these markets performed last week. And on the whole, things look relatively soggy, but not catastrophic once we take a look at the total results. So the S&P 500 down a little bit when we look at what's actually transpired here. NASDAQ down a little bit as well, but nothing like a huge destructive kind of a breakdown. Certainly not anything that would on net tell you that the markets had a significant amount of bearish conviction. I think when we consider here on the whole the performance across assets, what we end up seeing is a situation where the market, broadly speaking, continues the drive for lower interest rates. That's in the wake of the increasing conviction in the idea that we're going to get this rate cut in September. But when we put everything together here, the overall story looks quite a bit different once we start to unpick where these losses come from. And nowhere is this more interesting than it is in U.S. stocks. And you can see it here looking at the S&P 500. So here's Friday and here's today. So this is really where things start to get a little bit heady. And the reason that this decline is as modest as it is because, of course, leading into it, markets were kind of attempting to drift higher. And this is where things start to extrapolate on the conversation we've been having since last week, where it seems like really since the beginning of August, the markets are struggling to gain any kind of follow-through beyond 24 to 48 hours on any sort of meaningful catalyst, and thereafter they get stuck. And so we start with the markets at the beginning of the month fading what are generally good earnings reports from the first 6 of the Magnificent Seven. So we fade earnings, be they from Amazon or Google, or be they the explosive results from Meta. And in particular, those right here. There's a pop, there's a gap, and ultimately this comes apart. It happens again with CPI data, where we see the next big push. We take out these highs, we're not able to make any headway thereafter. We get another jolt from Chair Powell's speech at Jackson Hole, where he seems to endorse this idea that rate cuts are coming in the near to immediate term. Nevertheless, that fails to find lasting follow-through. We get another nudge higher, courtesy of Nvidia, which appears to produce at least something of an upside surprise, albeit it is the smallest margin of upside surprise for the company in going on 2 years. We still, at least, managed to come up with results that the market broadly judges are good enough. And so after a day of sogginess for Nvidia itself, we erase most of its intraday gains and we come up with ultimately a positive response from the market as a whole. Nevertheless, we still have a situation where within just 24 hours, the move fades again. And so it is with this that we enter this week looking at this performance and going, well, it seems like nothing happened. But if we consider the event risk on the board, we have a pattern that's emerging. And the response function seems to be, when we get a piece of news that can be rationalized away, we do so. But none of it seems to be giving the markets the kind of impetus that builds upside follow through, even as you continue to see this decline in yields, and ostensibly that the 2-year scores a bigger loss than what we have at the long end, tells you there's a level of urgency in rate cuts that's building into the system. In spite of that, incidentally, the US dollar manages gains up against the euro, up against the yen. Bitcoin telling a much more potent risk-off story, the high beta leveraged risk appetite sort of proxy that it is, down 6.9%. So the story last week, soggy in a modest way when looking at the averages, but dig into the internals and the price dynamics look relatively soft. It is with this that we start this week, and of course the performance at the beginning of the week here, this is just today's markets, not exactly encouraging. Stocks down significantly, although likewise significantly off the lows. We were down well in excess of 1% on both of the major indexes here, and clearly we've found a way to claw back quite a bit of lost ground here. Still, we end up with a down close on the S&P that the NASDAQ manages to erase almost all of it after hours. We nevertheless see that weakness prevails, and it prevails in spite of there not being a real meaningful catalyst to inspire it. The dollar only builds on strength, even as yields go higher with gold, which is a little bit incongruous. Typically gold, which yields nothing and is a kind of natural anti-fiat alternative, moves inversely of a strong dollar and of rising yields when that is the path for those. But clearly it still manages a strong increase. And so you get this sense of a kind of risk aversion binary in the markets today, where gold goes up, dollar goes up, stocks go down. Yields are the odd one out here. One would think they would be lower because bonds would catch that same haven bid, but that is not what is on the board. Raising the question about maybe there is an increase in uncertainty, maybe an increase from that in term premium and yields going up, not because of some sort of positive outcome, let's say a growth outcome that would diminish the need for Fed rate cuts, but going up for reasons of elevated uncertainty and a demand for greater compensation for that uncertainty from the markets. You do get a little bit of economic data on the board. The ISM manufacturing sector index comes out. It is a little bit soggier than expected, 48.7 versus 49 median forecast. So as ever, because this is in the logic of PMIs, where 50 is neutral, below 50 is contraction, above 50 is expansion, and the further you go above 50, the faster the expansion, the further you go below 50, the faster the contraction. The expectation versus realized result mix here tells you that you got the contraction as expected, but it was a little bit faster than the markets had benchmarked, if only by a hair. When you look at the internals here, you see that we've been running in contraction territory now for 6 consecutive months. Employment continues to shrink. It is well below the 50 line here. And the price structure a little bit better here. And on that basis, perhaps an increase in new orders. As the pricing structure here has cooled, so too new orders have rebounded over recent months, although they are still quite weak in terms of how fast the growth is going. But nevertheless, a little bit better. One wonders if this is happening because, as we've learned in the latest PPI data, companies are now passing through inflation costs to consumers rather than eating them. For the remainder of the week, we still have the service sector side of this equation, and that'll be an important touch point because, of course, services are a much bigger part of the overall economy than is manufacturing. The expectation that we're going to get a little bit of a pop here, a reacceleration, and the markets are going to be, as ever, very keen to see if that reacceleration exacerbates the sort of stagflationary messaging in the mix for employment and inflation within this data. If we take a look at how this has been developing thus far, we have increasingly on the service sector side elevated inflation. The latest numbers for this survey going back from July gave us the fastest pace of service sector inflation since going all the way back to August of 2022, whereas on the employment side, we are in contraction mode and, in fact, have been in contraction mode for a while. Employment expected to shrink again this go-round, although the forecasts are still modest and the sample space for them is very small, so take those with a grain of salt. But of the past 5 months, there's only been 1 month of positive employment growth recorded for the service sector, and that was in May. Otherwise, from March through July, employment has been shrinking. And in fact, the pace of contraction in July hit the fastest since March. And so the sort of divergence between employment and inflation is telling us that stagflationary story that the Fed is so afraid of. But of course, the most important piece of economic event risk on the board this week comes from the jobs report. The expectation is that we're going to get 75,000 jobs added in the coming month. That is a hair above the 73,000 in the prior. The unemployment rate seen going up to 4.3% for the first time since mid-2021. So the overall situation here is seemingly relatively modest. 4.3 is, of course, high relative to recent history, but certainly nothing like a problem historically speaking. And so we don't really have a major red flag necessarily in that increase, why the Fed might seek to delay rate cuts. And 75K would be weak. We of course, would need to look at the revisions, which have skewed toward aggressive negativity recently to get a more complete picture of the labor market. But of course, the concern becomes that the Fed isn't going to cut fast enough to head off what the markets seem to be worried about as an emerging downturn of significance. We can see here the markets now look at the probability of a rate cut at the September meeting, now only 2 weeks away, at 91.6%. The likelihood at this point, very, very strong, and this almost a foregone conclusion now. But where this data starts to become impactful is in the disparate setting for 2026. We can see that the Fed has been saying since December last year that it wants to do 50 basis points in rate cuts in 2025, and the markets are basically pinned around that. and have been going all the way back to essentially May. There's been a little bit of a divergence this way, a little bit of a divergence that way, but the baseline here has held quite firm. The big difference instead has been in what's been going on here in the outlook for 2026. The Fed said as of June, the last time that they updated their forecasting on this, that they're only prepared to commit to one rate cut in the forecast for next year. And when we look at what the markets have, clearly they are veering on 3. So the markets are ostensibly concerned that the Fed is not going to ease fast enough, that the Fed is not going to provide enough stimulus, or that at the very least they haven't owned up to the degree of easing that will need to happen. The markets clearly here saying, well, we're prioritizing dealing with a growth scare. We're not worried about an inflation scare, because what the growth scare will do is bring inflation lower. So this much seems like the critical sort of reaction function on this data. And so if we, for example, were to end up with a jobs report that were to deviate significantly in the negative direction, well, then the risk would be that the Fed is not going to commit to all that the markets are showing here, in particular, if we continue to get divergence between the inflation situation and the growth situation. What we've just heard from Fed Chair Powell, in fact, signaled significantly that the committee is more so concerned about the inflation piece than they are about the growth piece, even as they begin to ease. And so this sort of disparity would create the risk that the Fed is not going to deliver enough soon enough for the markets to get the backstop that they want. And this, of course, would be a reason for consternation. We likewise would see a sort of soggy response if the numbers were not as weak, but perhaps closer to in line, or perhaps even a bit stronger than expected, because for how much the markets want these rate cuts, if the probabilities in the wake of this data start to get pulled back a bit, even in relative terms, then perhaps the markets would get a little bit uneasy with that perspective, though that's probably going to require a very fine balance of data that's just a bit warmer, enough to get the Fed thinking, but not so bad that it would convince the markets that actually they don't need the rate cuts that they've been pining for. And that's a more delicate balance. In any case, what seems relatively clear here is that the markets are entering this week on soft footing, and that their capacity here to keep building higher, probably, given sort of the pattern that's developed since the beginning of August, will very much depend on event risk going in a tolerable way. And so looking at these ISM figures and looking at these jobs figures ought to be critical, and watching for their capacity to deliver follow-through even more so. Because for going on a month now, we've seen tolerable event risk give us 24 to 48 hours of exuberance, only for that to hit a wall and retrench. And that is Macro Money for today. As ever, we are here Monday through Thursday, right after overtime, a show I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go thereafter. Likewise, writing for the news and insights portion of tastylive.com. Commenting at Ilya Spivak on former Twitter and on Blue Sky. If you're watching on YouTube, like and subscribe. Macro Money is back tomorrow. Happy trading.
What is going on, everybody, and welcome back to Risk of the Week, or Risk and Reward. We got a new Risk of the Week. Today's Tuesday. We got a couple names we're going to get you guys' thoughts on. But before we get into all of that for today, Gus, my brother, how we doing today? We had a long weekend.
We did.
It was a little quiet.
We did have a long weekend. Yeah. I thought it's Monday all day, which is a double whammy. It's a double whammy because you keep doing things that you think you're supposed to do on a Monday, and then you're like, oh, it's not Monday.
Right.
And like streaming, like this is very strange to come in on the first day of the week and be on air with you in our Tuesday, Thursday slot. But the other side of that equation is every time I remember it's not Monday, I'm like, heck yeah, it's not Monday.
Exactly.
So, it's give and take. But red day in the market today. First solid red day we've had in like a while. I mean, which is funny to say, but like it started to feel like, a 0.25%, 0.5% red day is like a pretty substantial red day.
It feels like
in the state of this market. And all of a sudden I see a 0.8% red day and I'm like, the sky is falling. Are we going to fall apart?
It's funny you mentioned that because we also got bought back up. I mean, we put the low in today just right before 11 o'clock Central Time, and we've been bought back up and closed into the close strong, and we're still heavily down on the day. So with that being said, the market has been taking some aggressive moves to the downside. It was a 3-day weekend. Gus, anybody else that's in here, don't lie, who opened up their platform and recognized that today's not a full regular trading day. Did anybody open their platform on Monday? I think it happens to the best of us.
I definitely didn't myself.
Okay.
I was fully in tune with the fact that this was Labor Day weekend, but I will say that was something that I would do all the time when I was just a trader, like before I started working here.
Yeah.
But now having my like trading schedule tied into my work schedule, like knowing that if we're closed, the market is closed, that does well for me.
No, 100%.
Bob, Lone Sophos, Emmett, good to see you all in chat. Bob, go Buckeyes is right. I hit the nail on the head with that one. Buckeyes in the under. That was sharp. Happy to hear that you tailed that one.
Oh yeah, what's going on, Emmett? No, I mean, as we get in for today, I see we got the platform right here. We can actually just do a quick tour to market, and then we'll get into some of our risks of the week. As you can see here, we got SPY getting bought up into the close pretty strong, but I mean, we gapped down, sold off even more, put in the low right before 11 o'clock, and just ripped to the upside since. VIX, a little disappointing, but showing a little bit of promise heading in on this Tuesday, right? I mean, we got the spike in volatility over the weekend, and then the market's just ripping into the close, and volatility's collapsing again. But volatility tends to cluster, so maybe volatility picks back up. Hopefully this is a sign hopefully it's a sign that the market is going to offer us lower lows for the sake of a couple of the positions that I have right now. And then maybe we get that pop in VIX. You've been taking a look at VIX in a little while, right?
No.
It's been a minute.
I mean, it's just, it hasn't really been worthwhile for some time for me to be looking over at VIX too much. But yeah, we got a nice little spike as a result of all this action. It's just, I don't know. It's
been quiet.
It's such an interesting market too, because like I am just so aggressively bullish until proven otherwise at this point that like a day like today is like a pretty freaking bad day for my portfolio.
Yeah.
But I know that you're on the other side where you actually are short and need things to move down, and this like isn't enough for you. So it's just, we have a very interesting dichotomy going on here.
100%. With that being said, I mean, we'll see what we get for the rest of the week. Like kind of to the point that you made, Gus. I mean, with such a big down move, I'm now just barely break even, right, on the QQQ position. It's like we had a massive down move today, barely break even on that. We got some Apple in there. I did take it. Look, I did get a little bit of long delta on though. Last week when we got the sell off, I told myself I'm going to take advantage of this dip. I didn't take advantage of it in April when we sold off. So I was like, you know what? Let me get some long delta on an Apple. So we did that when the market sold off last week. Celsius, this was one of the risks of the week that we did, which was pretty fire. Celsius has been selling off a little bit more, put in a little bit better of a day for today. And now we're getting close to 50% of the potential profit on that trade. So maybe we take that one off tomorrow.
Yeah, the Celsius High Noon Corporation, is that?
The Celsius, exactly.
That's what you're talking about? Okay.
That was the headline that we were talking about. Let's quickly see how that panned out.
I don't remember exactly when that was. I'm sure we'd be able to see it. Maybe that gap down.
Let's see.
Yeah, for those unaware, we talked about it on stream some weeks ago, but Celsius had an incident where they're canned in the same factory as the High Noon vodka seltzers are
something
canned.
light.
And there was one specific Celsius can that had a run where it was a Celsius can, but it had High Noon inside of the can.
Yeah.
On like a specific blue raspberry flavor or something. But anyway, yeah, Celsius. I can't believe this company has survived. I mean, I was like reasonably
Celsius?
certain. I was reasonably certain Celsius was going to go bankrupt like 2-3 years ago.
Really? Why is that?
They had a whole. There was like a whole legal thing where the FDA was involved and they were like, they didn't like what Celsius was putting in the drinks. Maybe they had to change their formula or something. But I remember though at Texas A&M, Celsius was like a big sponsor of all the athletics and everything. And so there was always people like around campus just handing out Celsiuses. Like you'd be walking to class and then there's like, you know, like the Red Bull girls or whatever. Like somebody just gives you a Celsius.
Yeah, I know exactly.
Yeah, but I remember when they were starting to go bankrupt. Did they file bankruptcy? Am I crazy? Can somebody in chat confirm? Did they file bankruptcy or were they just close to bankruptcy? I know that Celsius was about to go under at one point, but when they were about to go under,
there was a massive rebrand.
Is that what it was?
I think there was a rebrand to where they changed most things to for Celsius. Yes, I think you're 100% right. Let me fact check it though.
When all that was going on, for whatever reason, they started like really forcing these Celsius cans on us, like the people around campus. Like they were clearly coached to be more aggressive in getting us to take the drink from them. If you politely decline, they'd be like, no, like take one. And then also if you said yes, they'd be like, you want like 3 or 4? So I don't really know. I never understood the calculus on that. Because how does giving away more free drinks, how is that conducive? Right. It never made any sense. I don't know. Maybe they were just trying to get more aggressive with their marketing.
Okay. I got you. So yes, anybody else can fact check this fact too, right? I'm going kind of quick here. But yes, the energy drink company Celsius almost went bankrupt multiple times in the late 2000s. In the early 2010s before it became a success it is today. This happened several years before the crypto.
That's all like 2010s though.
Hold on, guys. let me get to the bottom of this. But I do know Celsius did a rebrand where they were focusing more on like something to where it kind of boosts your metabolism, kind of taking like that fitness category route. And I know they saw a lot more success there. And I think it was a lot of like the marketing department. They made some changes and then took off. I don't even think they made big changes to the product.
Interesting.
I think it was just the marketing. I mean, turned the whole company around. It's crazy.
Yeah, interesting.
Crazy.
Bob, no idea about Celsius. I'll stick with coffee. I'm kind of with you on that one, Bob. I have an energy drink every now and then, but it's never Celsius. I don't know.
I just ordered a 21 or 18 pack of Celsius. It just arrived yesterday. So
interesting.
We're reloaded for the week.
Also at A&M, one time at a basketball game, we were like the Celsius power row or whatever. Like they pick one row of the stadium and they give us all a Celsius and they put us on the Jumbotron.
Right.
And this basketball game was like an 8 p.m. start time. And we would do this power row thing at halftime. So it's like 9 o'clock on like a Tuesday or Wednesday.
Yeah.
In the middle of the week. Then they just come to us and they hand us all Celsius and they're like, yeah, when the cameras come on, you got to chug these things. Everybody got to go crazy. You can shotgun it if you want. Like, just get amped. And I was like, I'll get amped, but I am not going to shotgun this energy drink at 9 p.m. on a Wednesday right now. I don't know who you think I am.
Yeah.
I feigned a little shotgun. We were on the end of the row from where the camera was, so it was easy to get away with that. And then just stocked those and had them at a later date. But but there was plenty of people, everybody on our row. Like we were in the vast minority. Everybody else was slamming.
I just can't do the shotgun with the energy drinks. I mean, the carbonation
it's the carbonation.
I feel like the carbonation's stronger in energy drinks.
It really varies because I know like Red Bull, even on the cans, it says lightly carbonated. Like that's kind of like part of their pitch.
Have you noticed they're a little lightly carbonated?
I have. I mean, I have Red Bulls around the office sometimes because we have them.
I peep that.
Yeah. I'll whenever I have one, I don't like carbonation at all. So I try to, whenever I pour a soda or a Red Bull or anything carbonated, I try to like get it to bubble as much as possible to get some of that carbonation out. So I'll just turn a Red Bull straight upside down over ice, and it has like no head on it at all. But whereas like if you did that with a Coca-Cola, you'd get it like halfway full and then have to stop and let it go down and do that a few times. So it definitely is lighter on the Red Bulls.
I gotcha. We'll get into the risk of the week right here. I don't want to give away what my risk of the week is too much as I'm on the position right now.
Errol's about to. Let's flip over to slides here.
No, we'll go ahead and shift over to slides. As you can see, the down day was pretty helpful for today. We'll see if the market wants to digest that into the rest of the week, but we can switch on over to the slides here.
Yeah, so as always, risk of the week. Those who know, every week we put on one high risk, high reward position. Let's dive straight in. Is yours first? Arrows is first. Go.
There we go. So give me 2 seconds just to load right here on my end. My risk of the week this week is going to be gold. Some might say, well, gold is ripping into the close, and gold is absolutely ripping into the close. Sorry, let me let this load. Gold is trading at, I know. Gold is trading at the highs right now. I wanted to sell an out of the money call spread, just get a little bit of short delta on. I don't feel, right, not that the market cares about our feelings. The market slaughters our feelings, but I feel like the market, there was a little bit of an overreaction today in the gold market at least. So I feel comfortable doing that, pretty decent premium. So I sold it in GLD. not GOLD for anybody that knows. If you know, you know. This was a defined risk position, so I feel comfortable trading a market like gold, especially as it's so volatile to the upside. And we're hoping this is going to be more like a little blow off top at all-time highs that we're looking at right now. And we're hoping that the Fed cut is priced in, or whatever the Fed is going to do, we're hoping it's priced in. So hopefully it's an overreaction. Hopefully we cool off a little bit, but it is defined risk. I collected about, I think it was $1.77. It was, yeah, collected about $1.77. It was a $5 wide defined risk. So we got a little bit of risk on that trade. And gold at its highs is definitely a risk of the week for me. Gold at its highs, because gold can be a different beast when it catches some momentum.
Yeah, Bob, I'm long-term hodl on gold. That sounds like it's going pretty well for you right now. Then, yeah, Errol's taking the contrarian angle here.
Long-term hodl gold is definitely a move. I like that. I like that, Bob.
Yeah, gold only go up. In the long term. But I can see this position having some credence to it. And this is kind of a cyclical market. You know, if you catch the right few weeks span, like you said, I mean, it can really move.
Yeah, no doubt, no doubt.
Yeah, it's an interesting one. But
what you got? What do you got for us?
Also, it just should be GOLD. By the way,
it's just right.
I've been saying for a long time it should be GOLD, should be the ticker for this, and silver should be SILV, not SLV.
It's SLV, right?
But SILV.
Yeah.
You have the room, especially gold. The word is gold. Like, what if your company was called, like, I don't know.
I mean, we have a gold, but they're on my head every time I trade GOLD instead of GLD or the futures.
I know it. Anyway, all right. Moving forward. My risk of the week, and I actually have not put this on yet because I'm playing a post-earnings trade from earnings that happened today after the close, is Zscaler. Zscaler, had earnings today, reported strong numbers. They're up 3 to 4% in post-market action. I'm going to get short tomorrow morning at open, but this earnings call, I've never seen anything like this, is very, very strangely similar to their last earnings call in May. In May, they beat EPS by 11.64% and beat revenue by 1.74%, and this month, just today, they beat EPS by 11.25% and beat revenue by 1.74% again. Same exact revenue beat to the 100th%, which is very interesting. So after that move after that earnings call in May, which was obviously a very positive one, as was the one today, these are earnings beats, the stock took a gap up and then quickly corrected itself. And it stayed higher at the higher highs, but it corrected itself downward from that all-time high that it made coming off that earnings call. We're in a very similar pattern here where it's shot up almost 4% in post-market action since these earnings came out, and I'm expecting a similar reaction tomorrow morning off the open. So, and I think that the bids tomorrow will come in, prop this up even higher at open, and I'm going to be able to come in and swipe that.
I got you.
I'm going to take a 20 to 30 day bear call spread and take advantage of some of that call side premium. I don't know exactly what I'm going to do yet, but yeah, I'm going to be getting short Zscaler.
Nice.
Don't say that, Bob. But anyway, that's my risk of the week.
Yeah, I like it.
All we got for the risks this week.
I like the Zscaler. I think the premium is really solid in there.
This is just my favorite type of trade. Is the earnings overreaction play the other direction? Because it's so. I mean, it's nearly impossible to sustain this kind of momentum, because it's like. Everybody, the earnings numbers come out, and everybody frantically works to price in this new information, as the efficient market does.
Yeah.
And then I just think that naturally winds up overextended, because as more and more people see the earnings call, more and more people come to buy, and it's just, usually you find that the momentum gets stepped on just a little bit after an earnings call of this nature. So, I'm just hoping for a slight, like even just 1% move back down in the next 20 to 30 days. Probably going to do that closer to 21 DTE, as this is a very short-term sentiment that I have, and I'm kind of just trying to play an intraday correction tomorrow. Maybe I'll do a weekly. I don't know. But that's where I'm at.
No, I mean, again, I like Zscaler. We'll see where the volatility is kind of sitting.
Oh, the tickers aren't 4 letters because they're on the New York Stock Exchange. That's a good call, Bob.
Yeah,
that makes sense.
Yeah. No, I mean, when it goes down to gold, GLD, whatever those might be, I don't know. It gets really hot in the kitchen sometimes. I know those individual underlyings. Usually, I'm a little bit more comfortable in, instead of trading those outright futures or some of those commodities sometimes. That's why I like the Zscaler position. I was really debating on choosing something like a gold commodity or a different individual underlying.
I will say too, I hate this company. Not like fundamentally.
Yeah, Zscaler. Why do you hate them?
It just frustrates me because we use it and it constantly keeps me from doing stuff.
Right.
And it frustrates me. Yeah. But we use it in our workplace.
Yeah.
Clearly people are using it and getting good use out of it. But then, twice a day, I'm like, Zscaler, why? I hate it.
I mean, the shareholders are loving it because post market 3 to 4% jump.
Man, screw the shareholders. Let me go on the websites I want to.
Come on, Zscaler. No, I know. We can start to jump over to the platform here. We'll check out Zscaler, see what they've been up to, see some of the market action.
You got gold typed in.
Hey, don't worry about. Hey, man. Don't worry about my gold over here. Just know me and my gold position are doing just okay. Where we at? You know, $2, that's paying for commissions already. And
free trade. Let's go.
Free trade.
Exit.
Yeah, free trade.
Close it out.
Putting my stop at break even now. We're up a little bit and don't want to lose any on this position. No, Zscaler was